sorry I'm a few minutes late. Welcome to the 2016-17 Malcolm S. Adiseshiah Media Review of the Indian Economy. This is an event that we much look forward to for a variety of reasons. First and foremost, it's an ongoing tribute to one of India's most prominent post-independence economists, Malcolm Adiseshiah, who had a distinguished career internationally, then returned back to India and invested heavily in both institution building, the manifestation of which is the Madras Institute of Development Studies in Chennai, but also, I think, went to the heart of the kind of policy discussion that we need in a country with complex challenges and complex problems to face. So it's with that idea that he instituted this media review at the India International Center. And it's a tradition that we have been on and off a part of, but now have been partnering with the India International Center consistently for the past several years. It's also a privilege to be a partner of IIC for another reason, that being that IIC's founder, C.D. Deshmukh, also was a founder, one of the founders of the National Council of Applied Economic Research. So we share a common heritage in that respect as well. I won't belabor because we have some very interesting things to discuss today. I'm privileged to have Dr. Pranab Sen with us. He is hardly a person who needs introduction. Chief Statistician for the Government of India, Chairman of the National Statistical Commission, and now continuing as the Country Director for the International Growth Center, the India chapter of the International Growth Center. I think Air Marshal Naresh Verma, the Director of IIC, was on leave today, so he could not make it. So I'm very happy that Amita Goel, Chief Editor of the IIC Quarterly, is here, and we are delighted to have her as well. I'd like to welcome all IIC members who are here, as well as prominent members of the research and policy community. We have a member of the MPC here, Chetan Kate, I see, Indira Rajaraman, who was on the board of RBI at one time. So we're really very privileged to have all of you here. I also want to welcome my friend from SBI, Soumya Chaudhary, who's here. Welcome. It's a great privilege to be here. Ghosh, I'm sorry. NCAER has become a very Bengali-oriented institution. Some of our youngest and brightest faculty are all predominantly Bengali, and so we mix up these names quite often, so I apologize, Soumya, but it's a privilege to have you here. So without too much ado, I'm going to just start things off. I want to just acknowledge the tremendous work that goes into the media review, and I want to compliment the two team leaders, Dr. Punali Bhandari and Maithili Pusarmos, who have, this is pure labor of, or love of labor, or labor of love, for the profession and the kind of discussion we have. NCAER does not receive any support for this, but we feel it's a very important part of our ongoing work on monitoring the Indian economy, and we are very privileged to be able to do this. With that, I'm going to actually pass the microphone to Dr. Sen and ask him to make some opening remarks. Amita, yes, no, you have to welcome everybody. This is your institution. We are just your guests here, Amita.
Yes, well, I'd like to welcome all my guests. As Professor Shah said, Marshal Naresh Verma couldn't be here, and he does send his apologies. He's traveling, actually, for the next 10 days. So it's my privilege to welcome you all. As you know, the mid-year review, as Dr. Shah has already told you, was set up by Professor Malcolm Adiseshiah, who was a life trustee of the center and also the convener of the Economic Affairs group here. And when he passed away in '94, he had set aside some of his assets to set up a trust, which was named Malcolm and Elizabeth Adiseshiah Trust. And since then, they have been supporting this. And as you know, we have been in partnership with NCAER for some years now. And it's been a pleasure. I have to say, in all these years, it's been a pleasure to work with Professor Shah and his entire team. I will especially mention Bornali, since we are in regular touch over the years. So thank you for that. And now I know that everyone is keen to get on. So thank you again. Welcome again. And I'm sure this will be as fruitful as it is every year. Thank you.
May I add my words of welcome to those of Shekhar and Amita. I've been attending the mid-year review of the Indian economy for a long time now. And there was a time when this was about the only mid-year review of the Indian economy that was available. That's changed now with the government mandating that the CEA is supposed to give the government's view on what's happened in the first half of the year. But nevertheless, this is and continues to be the only review of the economy that comes from a completely independent source. In the earlier years, actually, one looked forward to this review, not so much because of what it said about the midterm, but because it was really the counterpoint to the economic survey of the government. And that role, I think, it continues to play. And if you look at the document, I think everybody's got a copy of the report. It goes well beyond a mid-year review. It is a review of the past in a larger sense and a peek into the future. Last year was a little peculiar because when I was chairing this review at that time as well, because the entire focus of the discussion went away from what was happening to the economy to what was happening to the statistics, which are not necessarily the same thing. And indeed, we spent, I think, some nearly 4 hours discussing the new GDP estimates and practically nothing about what was going on in the Indian economy other than the fact we are in the second year of drought. This year, hopefully, all of that is behind us. And if any of you wish to raise issues, methodological issues of GDP estimation, last year I was the only one who was responding. Hopefully this year, the 3 who are in the firing line will take care of it, because I think there's now a lot more buy-in to the new GDP series than there was even a few months back. So hopefully we can put that behind us and get on with the business of actually reviewing the economy as a whole, particularly what's happened in the first half of the year and prognostications for the future. And it's with great pleasure that I invite Maithili to make the opening presentation. Or do you have?
Before Maithili does that, as I said, we have this influx of Bengalis coming to NCER, and our Bengali friends keep expanding all the time. So in that process, I've also forgotten to acknowledge my dear friend Shubhashish Gangupati. I just didn't see you in the corner there, Shubhashish. Welcome, and thank you for joining us as well. Maithili, over to you.
Well, thank you, Pranav, so much. Thank you, Shekhar, also. And as you said, earlier the IIC NCAER review, mid-year review, used to be one of a kind. In fact, there were virtually no other mid-year reviews. But now that there is a surfeit of information, we're living in the age of information, I thought I'd try and give it a slightly different kind of slant. So rather than just talk about the different sectors and the performance of the different sectors, I'm trying to interpret, given the kind of fact that, it's the interpretation of data, especially macroeconomic data, is something very, only the brave or the extremely foolhardy should even try to attempt. But I am trying to attempt that, so I'm trying to give it a slightly different angle. So I'm not going to give you a sector-wise performance of each sector of the economy. I'm trying to go and give you a sense of what is happening in the economy and what is it about what's happening in the economy that makes it so difficult to really come to any definite conclusion. So we are living in the age where I think there are more questions than answers, and as long as we accept that this is the age of questioning and nothing is cast in stone, I think we are doing reasonably well. So with that, let me start and welcome all of you. So I just thought, let me just very briefly tell you what the macroeconomic performance was, because whatever happens in the future is rooted in the past ultimately. So are there pluses and minuses? Do the pluses outweigh the minuses or the other way around? What are the near-term challenges in the forecast and outlook? And as you can see, I do the easy part of it. I tell you what happened. In the Indian context, even telling you what happened is not very easy. We're still trying to debate whether the Babri Masjid, what was there a temple, was there a masjid? So in India, the past can always be questioned. But even so, I have the relatively easy job of telling you what the past was like. Bornali is braver than I. So she tries to tell you tries to read the tea leaves. So all shoes, rotten eggs, tomatoes, please aim them at Bornali, not at me. So with that, let me just go back to what we were like in 2015 when we presented the media review last year. It was a rather unfortunate period because, as Pranab said, not only because of the GDP data, but also because of so much political impasse, etc. Things was really a period when a lot of the promise that there seemed to be when the Modi government came to power that seemed to have kind of somehow disappeared, vanished. And so the only good thing really about the second half was we thought we might get an undeserved second chance because we really had, not thrown away the chances in the first half. So because oil prices, commodity prices were still low, we had an undeserved second chance. So now we move forward. Now, did we really use that second chance? We were lucky, we got a second chance. What was the first half like? And I would dare to say, really, stick my neck out and say this is a period really where a number of factors, including our parliamentarians who are not known for the best of behavior, they suddenly seem to behave, fall in line in the only way they can. I mean, they can't do better than this, but at least to the extent that there seemed to be some sense of responsibility. We did see some legislations getting passed, so things seem to be going our way again. In November 2015, we'd asked this question. We were really thinking that the future was before us, and what would the world see us like in November 2016? And the answer, I think, is very clear. I mean, we may not have got there. We've got a long, long way to go, but there's no doubt about it that we're suddenly everybody's looking at India with new respect. And as you can read the quotes, and this is just a sample of the quotes from World Bank's officials, investment bankers, etc., and they all tell us that we are harsher on ourselves than the rest of the world really is. That is the essence of what they're saying again and again. That India is in a far better space than it was before. Is it good enough? Most certainly not. But it certainly is better, and rather than perhaps always complain about what is not, maybe we need to think how can we build upon it. So in a nutshell, if I were to put it, so this is what we said in November 2015, drawing from Charles Dickens. We said it was in fact the worst of times because we really lost our way, we hadn't utilized the opportunities, and there didn't seem to be much future given the fact that it was a political impasse at many levels. And I am contrary to many. I know Chetan sits over here and we, I think, see things diametrically opposite views, that I think any analysis or study of the economy must be rooted in the political economy. The excessive use of mathematics and models takes us away from the fact that we are essentially dealing with human beings. So because of the political impasse, it really was the worst of times. There didn't seem to be any way of getting out of it. So how are we looking at it now? We're modifying that really. To say it's the best of times once again. But it's also the most tricky of times. It isn't the worst, but it certainly is the most tricky of times. Why do I say that? I'll elaborate. So why is it the best of times? Let me just try and explain. So if you look at all the sectors that I've highlighted, whether it's agriculture, whether it's manufacturing, services, I don't think anybody will dispute what I have said. That manufacturing, there are faint signs of revival. We can argue what is the extent of the revival depending on whether you look at the IIP or whether you look at the manufacturing data or the CSO. Services, as always, has kind of held us out. Bond yields are definitely lower. Why, we can understand, we can discuss, but the fact is they are lower. Retail investors suddenly seem to have rediscovered the magic of the stock market. Inflation is certainly under control, forex reserves. So on all these fronts, we certainly seem to be, if not in the best of times, that is a bit of an exaggeration, but only I'm using a little bit of my journalistic license over there, it certainly is a pretty good state to be in. But why is it the most tricky of times as well? Because there are many negatives, and some of these are really serious negatives, particularly as far as gross fixed capital formation is concerned. private investment just doesn't seem to begin. It seems very, very shy. Despite whatever the government has done, we don't see private sector, private corporates stepping up and coming in and investing. Government has been investing, but there are limits to how much it can invest, given the fact that the fiscal situation in India is never very robust. There is a very tepid revival in manufacturing. Growth in bank credit, Soumya will tell you more about it, is certainly very poor. One can argue that it's because of non-performing assets, and unless one does something about the systemic issues, you're not going to see a growth in bank credit. But to the extent that we are essentially a bank-driven economy, unlike many other countries, we are almost entirely dependent on bank credit. Unless we have growth in bank credit, and growth in bank credit, I'll explain later, to the corporate sector, not necessarily to the retail sector, you are not going to find growth supported. The fiscal situation seemed to be under control, but now as we look at the latest numbers, again we are having worries on that score. Growth has been and continues to be largely jobless, so the entire talk of the demographic dividend has fast become a liability, and that has got serious socio-political issues that we really need to address. Exports, and we keep saying that, look, the world is not growing, the global demand is very slow, that's why exports are not growing. But let's not forget there are many countries in the world which are doing very well in their exports. Bangladesh, Vietnam, Indonesia, these are all countries whose exports are doing well. So these are really mainly excuses that we have. And global slowdown is always a factor post-global financial crisis. And the Indian subcontinent, we can never ignore the geopolitical anxieties. We live in a subcontinent where perhaps we are the only oasis of some kind of stability. So we're always, on the brink, as it were, externally. Domestically, our social fabric is always stretched thin. And if you don't find growth and employment and the benefits of growth filtering down to the have-nots, it's going to find that social fabric stretched so thin that we might not really be able to talk about a future for the country, really. So, despite all that, do I see the glass as half full or half empty? I must stick my neck out over here and say I certainly see the glass as half full. And this comes to my rescue. What comes to my rescue really is Smythe's law, that where you stand really depends on where you sit. Unfortunately, as I said, in India, almost every debate, even on the economy, takes on ideological hues. So depending on, the moment you say, well, growth seems reasonably okay, you immediately say, oh, you're a BJP wala. If you say growth is bad, you're a Congress wala, as if there's nothing in between. You can look at issues. Unfortunately, that never happens in our country. We always like to bracket people. So it's not as if, okay, in certain things you could agree with the BJP, certain things you could criticize them. So essentially, this is a problem, that where you stand on an issue essentially depends on where you sit, tragically. The good thing really also is that Joan Robinson said, whatever you can rightly say about India, you can just say the opposite with an equally straight face and nobody really will be able to contest that. So I'm accepting that almost any opinion that I have, regardless of what it is, whether I say it's half full, I'll find people criticizing me saying it's it's half empty. So I could say, okay, fine, I agree with you, it's half empty, and the same person could turn around and say, no, I think it's half full. That is the beauty of our country, our culture, whatever you can say. Everything goes. Okay? So, but how does the external world look at us? How do multilateral agencies, who are not known to love India very much, because we tend to kind of speak our mind, but what do they say about us? If we look at what the IMF has been saying about us, they've been saying that we're pretty good boys, they're patting us on the back, and they continue to pat us on the back, even as they continue to kind of look down on the rest of the world. So if we look at the latest numbers that we have, I think India is perhaps, 7.4, 7.6, they lowered it to 7.4, then again 7.6. So India is the only country where we really seem to be doing okay and doing better as time goes by. And this is not from it's from I wouldn't call a harsh critic, but a critic who's not overly fond of us. Okay, but then you look at it, okay, so India is doing pretty well, you say, but then is that only because it's doing well in absolute terms, or is it because everybody else is doing so badly? I wouldn't dare to repeat what a former governor of the Reserve Bank of India said and got so much flack for it, but the fact remains that we look good only because the others are looking so poorly. So this is the fact that, yes, we seem to be doing quite well, but that's because all our other bricks, the other bricks on the wall, are all doing so pathetically. Even China, which was, doing reasonably well, has slipped, and then we always get a lot of cheap thrills saying, yeah, we're doing better than China, not remembering that when it comes to our per capita income, China is many times that of India's per capita income. So is India shining? Only in comparison? Certainly, it's only in comparison. And particularly, if you look again, and this is what I'd like you to look at, because unfortunately in NCAER, we don't really have a full section on the social sectors. So if you look at how India is doing, yes, in terms of GDP, very good, we can pat ourselves on the back. If you look in PPP terms, we're looking not so bad. We look a little much better. As against 11, 16, 17, we are up to 6,162. But look at our HDR. I mean, where are we? 130. That's what should make us pause and think that even as we do a mid-year review, and we call it a mid-year review of the economy, we must look at it as a review of the mid-year economy, socio-political economy. That's what I would like to look at as. We look at the economic numbers, but through the prism of what is it meant for our people. So the problem is that I said there are many macroeconomic puzzles, and I really like this quote of Dr. Y.V. Reddy, so I've happily lifted it from him. India, it's not only the future that is uncertain, even the past is uncertain. And as Pranab just certified, we can go on endlessly about the GDP numbers, and Pranab will say that that's why perhaps CSO hasn't come out with the previous series. They're faint-hearted at that, because you never know, because even the past is uncertain. So as I said, even though I thought I had the easier job, not necessarily so. So if you look at the puzzles, and how do you see? The GDP is down, but GVA is up. So what do you look at? GDP, GVA, anything? IIP is low, manufacturing is much better. We have a boom in consumption. If you look at Maruti cars, last quarter Maruti actually reported a 60% increase in profit. People would kill to come to India and sell if they could get a 60% quarterly growth in profit. So you have a boom in consumption, but where are the corporate profits? Canary Islands, Cayman Islands, I don't know, but they're not here. Inflation, the CPI is down, the WPI wholesale price index seems to be going up. Tragically, as I said, the rural inflation seems to be more than urban. And ironically, this is so even in food, for which I really haven't got any convincing answers. Ask around, people tell you that, well, because there are greater rigidities in the rural areas. But I, on the contrary, thought that actually there are lots of middlemen and there are lots of distortions in agriculture. So food should be cheaper in the rural areas. But this is what we are finding, that rural inflation is higher than urban inflation. Gross fixed capital formation, as I said, is down quarter on quarter. But what most people seem to have missed, and there's a lot of criticism really of India on this, because our capital formation hasn't gone down. Has gone down rather. But if you look at it sequentially rather than quarter on quarter, there's a very faint, I repeat, slight increase. So as I said, there are many macroeconomic puzzles that one really needs to try and figure out what is happening in the Indian context. So you look at GDP or GVA. Take your pick depending on what you want to see. GDP, yes, you're down. But if you look at GVA, which I think is a better number, because that is a measure of your economic activity, then GVA is certainly not so bad. We're marginally up, particularly as compared to the previous quarter. Not previous quarter, the first quarter of the last year. So depending on what you want to see, and by and large you will see we're faring not too badly, except for Q3 and Q4. By and large, both GDP as well as GVA has held up. Rains, as I said, are better. Rainfall deficit, the rain gods have been very kind to us. So that has come to our aid undoubtedly. Unfortunately, more than 60 years after independence, we still need to look at the rain gods. That's not a good sign, but yes, we have decent rains this year. This is just a map showing you that there are very few parts of the country really which are deficit. Most of the country has received adequate rainfall. Manufacturing and services are holding up. If you look at services and manufacturing numbers, they aren't too bad. As against the IIP, you have manufacturing doing not too badly. Services, of course, has always come to our help. The other sectors, notably construction, is doing badly, but by and large, if you look at manufacturing and services, which are the key sectors of the economy, particularly manufacturing is important because of the jobs. The jobs have to come from manufacturing. Given the fact that you have this huge skew in the number of people, the percentage of the population dependent on agriculture, and the share of agriculture in the GDP, if you want to give jobs to people, you have to take them out of agriculture. Where can you take them to? Which sector can you take them to? You cannot take them from the farm, in front of a bullock cart, in front of a tractor, maybe on a tractor, and put them in front of a computer. You necessarily have to put them at first, perhaps on the shop floor. So the jobs have to come from manufacturing, which is why I put so much emphasis on manufacturing, because services cannot give you the jobs. Services can give you the growth, but not the jobs. So this again, as I said, I've taken the liberty of lifting from everybody I could lift from. So this is, as I said, I've taken from with William Butler Yeats. So things fall apart, the center cannot hold. But here we have the contrary situation where the core sector has not performed too badly, if you see. After the dip in May, it has been reasonably okay. And we've got this kind of contrary signal where the core sector does well, IIP does badly. IIP does badly, manufacturing does well. So there are these puzzles, but to the extent that the core sector is the basis for any kind of growth of the economy, I'm reasonably hopeful that if the core sector holds and growth continues to be positive, continues to be decent, particularly last month we've seen good growth in the steel sector, then things really cannot fall apart. Things have to at some time look up. It's a question of when. Current account deficit is sharply lower, but on this again, as I said, everything about India, you can say one thing, you can say the opposite thing. Yes, it's good because we don't have external sector vulnerabilities, but what you have is a low level of equilibrium. Your current account deficit is not an issue because your exports are low, your imports are low, the economy is not growing. So you don't have to worry about the current account getting into trouble, but you do need to have a current account deficit. A developing country does need to have a decent, safe current account deficit, because it's only when you run a current account deficit that you will have a capital account surplus, and we do need to have some money coming in from abroad. So the current account deficit being low is good, but not necessarily the best of the worlds. So if you look at gross capital formation, and this is where I want to spend a little bit of time. So if you look at Q1, it is certainly higher than the current prices of Q4. It is marginally higher at constant prices also. Yes, it is lower than the Q1 of the previous year. But if you look at it sequentially, there does seem to be some, if not an increase, at least a certain constancy. So maybe I'm clutching at straws, but I think the kind of very bleak picture that is pointed out about gross fiscal capital formation, I think is a little excessively overdone. Because yes, you cannot really expect to have the kind of gross fixed capital formation that you had in the boom years, but even at 28, if you have an ICOR that is shows you the efficiency of capital, if you could improve your ICOR, then even at 28, there's no reason why you cannot grow it well over 7%. If you have an ICOR of 3.5, we're roughly supposed to be at 4, that should give you 7, but if you have about 3.5, there's no reason why a gross fixed capital formation of 28 should be so bad. Okay? Lots of IPOs, all doing very well, but can you smell any investment? Not if you look at the gross fixed capital formation numbers. So even though the amount raised has been much, much better, if we look at 2014, it was just 5. That was the year the Modi government came to power. And in the first half year itself, we've already had 20 IPOs. And we have raised a substantially higher amount. And there are many still in the pipeline. So IPO shows you fresh investment. Unlike the stock market, I completely disregard the Sensex, because the Sensex is basically money passing hands from A to B. It doesn't bring any fresh capital. Whereas IPOs are what bring you fresh capital, what shows you the kind of state of investment, the state of mind sentiment. And here we see there has been a dramatic improvement. It's not showing up yet in the fixed capital formation numbers. Yes, I concede, but maybe it's there, it's hiding. It will come to the surface. This again is what I wanted to point out about how, unfortunately, as I said, if you look at food inflation again, tragically the urban is 2.88, the rural is 4.43, and I'm talking about food inflation. This, to my mind, is something that should worry policymakers. Why is it that food inflation is so much higher in the rural areas than in the urban areas? Because you're talking only of food inflation, and even if the Reserve Bank does not look at food inflation, it looks only at CPI. Given the fact that food is a major component of the CPI basket, I think we ignore this development at our own risk. The RBI has an inflation expectation survey, which is, I think, to my mind, a very inadequate survey. It used to be only in the rural, urban areas and very small sample. Now they have increased that, but even so, it is a very grossly misrepresented, inadequate survey. And unfortunately, earlier at least, the RBI used to attach a great deal of importance to inflation expectation survey. Ironically, it would seem, because the entire purpose of the monetary inflation targeting was to anchor inflation expectations. But as the latest inflation expectation survey has shown, despite the low inflation that we've had, inflation expectations have actually gone up. So this, I'm sorry to sound so cynical, but that stems from a basic cynicism of a lot of the surveys that are done, which I think are not very representative. So credit growth again has picked up. We are seeing some improvement in the credit growth, but unfortunately most of the credit growth is in the retail sector. So everybody wants to lend to people to buy cars, because if a person doesn't pay back her loan on the car, you can seize the car. If you lend to Vijay Mallya, it's a little difficult to catch either the man or his aeroplane. So you'd rather not lend to him, you'd rather lend to you or I, because our cars can be taken, they can send gundas after us, our houses can be repossessed. So retail credit is what is coming. It's not a bad thing in itself really, because ultimately if I buy if I'm getting loans to buy cars, I'll buy more cars. Ultimately, it has to translate into more demand for cars. So Maruti, all these people have to expand their production capacity. But it's not sufficient. So this is where we need to see more growth. Unfortunately, we are not seeing any increase in manufacturing growth for a variety of reasons, as I told you. Unfortunately, we went after the public sector banks, particularly hammer and tongs, not realizing that the public sector banks were actually what came to our rescue in the years immediately after the crisis, when all lending stopped. It was only the public sector banks that lent, perhaps a little foolishly, but they kept the economy afloat, and today they're paying the price for it. So you are finding manufacturing growth not picking up because the public sector bank said, why should I lend? Even after I lend, if I'm going to have the CBC, the CBI, the ED, and every Tom, Dick, and Harry come knocking at my door saying, why have you given the loan? I'd rather not lend. Because in the public sector, as you know, you can only be hauled over the coals if you make a mistake. If you don't do anything, you can't be hauled over the bricks. So why not? Why do not anything at all? So FIIs, foreign institutional investors, of course, have been rushing in, and this is what has come to our rescue. Because it helps in two ways. It keeps your bond yields low. It also helps to kind of bring in foreign money. So we are getting a lot of money coming in through foreign investors. There's no surprise, they're no fools, because they're giving them 7.05 with the rupee rock steady. This is money for jam. So look, that's why they're all coming in, not because they love India or any such thing. But it's not only to India, they're going into other countries also. So if you look at other countries, there are, there's huge amount of money coming to other countries. So it is not as if they're coming only to India. Look at countries like South Korea. They have received substantial amount. Brazil, even with negative growth, is receiving substantial amount. So FIIs have been coming in, but not only to India. They've been coming, and it does help us. But the problem with FIIs, it's easy come, easy go. So what we really should be aiming at is foreign direct investment. This year, unfortunately, foreign direct investment has not done too well, but foreign direct investment tends to be lumpy. So if we are going to see the kind of deals that we're seeing in the recent past, mergers and acquisitions particularly, I think we should get a fair amount of money coming in. So as I said, foreigners, of course, have been keeping faith in India. If we look at tourist arrivals, which I thought was a good proxy for the service sector, we are seeing a pretty good growth as far as foreign tourists are concerned. Well, the global outlook is certainly more rosy. We'll turn our attention overseas. So if you look at the Fed midterm projections, what they had said earlier and what they are saying now, certainly it is better. And the latest GDP numbers, Q3, the third quarter GDP numbers for the U.S., it's 2.9. That's close to overheating for the U.S. economy. In fact, there should be serious worries. But for the elections, perhaps the Fed might have raised interest rates in the just concluded meeting. But though we like to pretend that the Fed is independent, has no political overtones, the fact is that politics has overriding influence of economics. And clearly, Fed did not want to rock the boat just a week before the elections are due, particularly elections where it's going to be a very close call, and God forbid. In fact, I think in one of my quarterly reviews, right in the beginning, when Trump was just emerging as a candidate, I said, pointed this to be one of the possible risks, and everybody laughed. Donald Trump becoming U.S. president, it seemed unbelievable. But today, as we're seeing, perhaps it's not all that unbelievable. Okay, so but is the commodity cycle reversing? What is the commodity cycle like? We saw all items were, earlier it was minus 17.8, that was what it was like, food. Then we saw September, there's an increase. Oil, and this is what I'd like to point out to, particularly because oil, we saw there was a sharp fall in the price of oil, and this really helped us last year. It came hugely to our rescue, A, for inflation, B, for our import bill, 3, for subsidies. So anything that happens to oil impacts us on 3 fronts. This year we're seeing that while oil prices remain low, there is no certainty about it. And though the OPEC is not particularly a reliable kind of entity, one cannot say whether they will finally reach some agreement. So we will not get the kind of lift that we saw last year. So oil certainly is of course a worry. Gold is presently up 19.4, but the only thing that has happened that is good is that the government sovereign gold bonds seem to have done fairly well. We're now into the 6th tranche. So even if gold prices go up, and likely to go up even further now with the US elections, I think this need not worry us very much. But what I think we need to think is that the commodity cycle could reverse. And what does it mean for India if it reverses? So the good luck that we had counted on in the past may not continue to hold in future. Government, of course, as I said, thanks to the fall in yield, has saved hugely on interest payments. Last year also they saved on interest payments. so too this year as well. And this is going to come to the rescue of the government at a time when the fiscal situation does not look too good, particularly with the pay commission recommendations, particularly with disinvestment and non-tax revenues not doing so well. Tax revenues again are not doing too well. Stock markets, I said, well, no longer irrationally exuberant for the simple reason that I think, unlike in the past, today there is some reason, there are some underpinnings for the stock market becoming exuberant. There have been ups and downs, as is inevitable in the case of a secondary market, but by and large there is reason to hope that there is some growth happening in the economy. Not only I ignore debt markets for the simple reason that debt markets come in mainly for arbitrage, whereas equity markets people come in because they think there is going to be growth in the economy. So I would like to think that they are not irrationally exuberant. So what really is the billion-dollar question that we have right now? Well, what are we? What the economists once dismissively called us a nearly par. I think the economists, I hope there's nobody from the economist here. The economist still thinks we're still a colony of the British. So they always like to talk of us in slightly contemptuous ways. So they call us a nearly par. We're always nearly there, never there, right? So, or a lumbering elephant. But I'd like to look at us as a tortoise that is finally picking up pace. And as we know, it was the tortoise which finally won the race. And if you're picking up pace, then maybe, just maybe, things could not be so bad. So the thing is, how does one make sense of mixed signals? And I put this quote, and I deliberately haven't put the name of the person who wrote this, because I said, when I venture to say that the glass is half full, and I give you such a mixed picture, then on what basis am I saying this? If I'm giving you contradictory signals, and then I'm saying the glass is half full, on what basis am I saying this? And this is a quote that I kind of liked, because I thought it showed a humility rare among economists. The events of the past few years have revealed limits to economists' understanding of the economy, and suggest several important questions I hope the profession will try to answer. Who is the author? Any guesses?
Yes.
Who?
Joseph.
No, sorry, Janet Yellen. So if she, as I said, if she has a humility to confess that we really don't know, I mean, the whole, particularly the fundamental principles of macroeconomics are under complete scrutiny. You pump in money, interest rates stay low, inflation stays low. What does macroeconomics teach you? So where are we? We have to go back to the drawing board and try to see, is there something about the new economy that we really don't understand? So here is an economist, the chairperson, as it were, the Federal Reserve. She has the humility to say this, which many economists, and I don't even pretend to be an economist, so I certainly say that, we really do not know. So we'll have to take things as they come, try and, understand them with the humility that maybe we are wrong, rather than saying that this is it and then refusing to go back, which I think has sometimes happened with some of our policymakers. They take a position and regardless of what is happening, they refuse to reconsider. And that, I think, is something that is very important that the economics profession, particularly macroeconomics profession, must need to reconsider. So what are the near-term challenges? As I said, you may read this, we have to revive investment, improve productivity, nothing really changes. So this is what I said when I looked at last year's presentation, and I found that everything that I'm saying today, I said last year also. So does nothing seem to have changed? Am I once again bringing you a contrarian view? Well, I say things have improved, but then nothing seems to have changed. The challenges remain virtually unchanged. These are the internal challenges. Why are they unchanged? And despite that, why do I say that I'm relatively more optimistic? Precisely because I feel that even though things have not changed, they're changing. So that, I think, is what has made a difference. We are trying to do something about each and every one of these heads, whether it is investment, manufacturing, we're trying. And I think as long as you try, and you try sincerely, things will not change overnight. And in a country like India, I think it's dangerous also to attempt overnight change. We are a democracy, you have to carry the last Indian with you. It becomes important in that sense to ensure that whatever the government tries to do has acceptability, if not complete acceptability, at least broadly the direction should be something that people do not disagree with completely. So even though nothing seems to have changed, the very fact that we're working on it and things are changing, I'm hopeful. On the external sector, again, if you look at it, very little has changed here also on the external sector, except that the Fed has raised interest rates. Maybe this year, before the end of the year, in December, after the election results are over, the Fed will hike rates again in December. I do think that they will hike rates in December rather than January, because January will just be the opening days of a new presidency, and the Fed would not want to rock the boat then. So any opportunity for them to hike rates is either in December this year or maybe much later next year. Given the fact that the U.S. economy does seem dangerously close to overheating, I think this is an opportunity for the Fed to hike in December when there is still an old president. Obama is still technically there. The new presidency hasn't come. The Fed can appear independent, though, as I said, no central bank anywhere in the world is truly independent. It's a lot of hogwash. Okay, in the face of all this, my question is, can we really make it? So this is, of course, a wonderful Indian elephant, beautifully decorated, and some of the centers pulling, the states are really pushing, and I think this is what I showed last year also, I must confess, because there really is, because everyone, the states, and this is why I'm really hopeful, because today the center and the states are working as partners. Gone is the days of Congress when you have a centralized government telling the states what to do, where they came, begging bowl in hand to the planning commission. Today the center and the states are working together. I think you have a prime minister who's worked as a chief minister, who's been at the receiving end, and knows just what it feels like to be told, okay, here's a little pound of flesh, go and spend it, don't come back for more. Because it is the money which belongs to the people of this country. They happen to reside in the different states. It's not the centers to give. So this is why I think we're hopeful. Why do I say that, as I said? Because after a long time, the center and the states are working together. We're finally working on the economic plumbing, something that we never addressed in the past, single window clearance, self-attestation of forms, small things which don't really translate into very much because there has to be certain traction. But it will take time, and reforms are continuing. So net result, as I said, I come back to my point, the glass as I see is half full, not half empty. Of course, being Indians, we're completely capable of throwing away that half full glass and making it completely empty once again. So that is up to us to ensure that we build on that half full glass. And this is why I come to my last slide, after which I hand over to Bernali. So here again I've taken liberties. It should be in the affairs in the tide of men. I've called it nations, because I think this is really an opportunity for India to do something. We've been at the cusp of a great opportunity, and we've been given this opportunity not just once but twice. Because commodity prices have fallen so dramatically, it's really given us an unexpected opportunity. So if we take these opportunities that are given to us, build on it, and not squabble about stupid, useless things, then maybe we will be able to get there. The glass can be completely full. And with that, I think I move on to Bernali. Finish on. Come here. Why did you come here? Or I'll move for you. Yeah?
Good morning. So I'm doing the foolhardy task of looking at the tea leaves, and my approach is we have to look at the numbers, and while we both use two different approaches, I think our conclusion is the same overall, where we find that there are mixed signals coming. And this time around, I mean, I have been hopelessly, since I started doing this, I've been hopelessly very despondent about the numbers that were coming. That this time around, for the first time, when you look at the numbers, I think there's a reason to look at the glass half full. And before I go on to my forecasting, I just want to look at some of the very key indicators, without taking too much of your time, key indicators of why there is reason for hope. Just reason yet, the sustainability is, of course, a big question. The first is, of course, the rainfall, a map which is already showed. It has been temporary and spatial even monsoon, well, almost. One of my favorite states, Kerala, actually has in a deficit, which means it has implications for both power and of course, electricity prices, and of course, access to water and otherwise. So that's one. That southern region has received deficient rainfall, and so has northeastern India. So there's been almost there, and that's good news coming from the last 2 years. So we are, based on this, with its implications for the rural area, would hope that rural demand would now increase. And how do we know rural demand would increase? We would look at demand for tractors, trailers, two-wheelers, and if you look at the similar kind of statistic as the Maruti, if you look at the SIAM, the Society of Indian Automobiles Manufacturing Association, they're showing that sales have been going up in double digits for all motor vehicles, including two-wheelers. So there are some positive signs, but of course sustainability is a big question. The second graph, which is a reason for hope, is the NCER, along with this the review of the economy, we also do something called the Business Expectations Survey, which is done every quarter. We survey about 500 to 600 firms across 6 cities. We ask about perceptions, and one of the 4 parameters. Again, this has been going on since 1991. The 4 parameters, and amongst them, one of them is where we actually ask about the present investment climate, whether the present investment climate is strong compared to 6 months ago. And this number is essentially showing that since January 2013, that it has been below 50%, except for the brief time during the elections, before the elections, right here, that it has been persistently below 50% of respondents have said that present investment climate is not strong. It's only now in the red part is when in October 2016, which is the yet unpublished survey, which is showing that around 50% of respondents are saying that the present investment climate is positive. And that's somebody who we have been looking at these numbers for a long time, the last quarter, for the almost last 1 year, and has been below 50%. So there's perhaps one more reason for hope. Of course, it may not be sustainable again. The next one is the PMI the Purchasing Managers Index produced by Market Economics. Here, when we look at manufacturing, which is again something Maitli has talked about already, so I just want to talk about this part again. It has this Purchasing Managers Index above 50 includes acceleration, shows acceleration. What we find is that the PMI has been steadily going up, but this point here from October is when we see some acceleration. So what a lot of us, and my colleague Devendra Pant actually used the words, that the economy is moving but not accelerating. And for the first time, we see some acceleration. And we've got the same results from the business expectations till July. It's October one, which is showing some movement. When we look at services, the available data is only till September. This is showing that the services is trudging along, going up and down the story, and the overall composite reflects the movement of the services sector. So the October data shows some uptick. That's the one next positive signal. The third one is a point, again, Maitli has already covered about why aren't the corporate profits showing up. Similar concept here, this is the CMI data when we should look at the quarterly CAPEX aggregates from December 2015 to 16. Again, we see that September 16, number of new projects have increased, completed stalled projects have gone down, revived projects have gone up. This is rupees trillion. So again, we see some movement in the second quarter. The core IIP, again a point which Maitli has mentioned, but here again I want to show this red tail, and sorry about the combination of colors. It looks like a dragon, but right here again we see some movement in the sector, again after having been volatile for quite some time. And primarily in the September one, it is driven by the steel sector, but the steel sector has come under protection for the last couple of months. So is it going because of its own dynamics, or is it going because of trade protection? Is there something up for questioning? But other than coal and coal and other natural sectors, all other sectors are showing some movement, and even cement has shown some movement in September. Last but not least, we know inflation is moderating, so I didn't want to repeat the same numbers here. I just want to again indicate that why there is reason for hope. So I looked. I'm not putting in WPI and IIP because WPI has longer numbers. When we here have deseasonalized the data, and then looked at taken out the cyclical components to understand whether cycle is changing or not. I look at both growth rates, inflation rates, and the index itself. And while this is a very interesting number, is that there's almost, you can see the output inflation trade-off almost. But here with this red line is showing that inflation is going down, whereas output IIP is slightly going up. So when you similarly, the growth rates are still not so clear, but I just wanted to put that up and show that there is some there's some diversion going on here. So again, we don't know with sustainability, but given that we are looking at this combination of indicators, and this hasn't happened before, again, as I've been following up, it has been one or the other, but not on a sustainable basis. So combination of indicators have shown that perhaps the first half of the year is over and the second half year, perhaps there are some green shoots. Similarly here, after being in the negative territory for almost since even before April, whole of last year, we see that exports have gone up very marginally. Maybe it's just a base effect, but it does show some positive movement. Then if you look at bank credit to the commercial sector, similarly, again, all the volatility aside, if you see the red tail again, the dragon again, the red tail shows significant movement in September. Again, if you look at it at a longer series, it doesn't show. This is even more evident. So, given this mixed signals, we looked at the tea leaves, and overall, of course, the numbers are just too small to show any visible upward movement. But I think first a push to rural demand and the implementation of the 7th Commission on the urban demand, and some movement on IIP, and probably the most important thing is when we look at gross fixed capital formation of that it has been going at a negative territory for 2 months. But the more that there's possibility of investment sentiment improving. So even because we didn't show IIP capital goods, but IIP capital goods has been growing negatively for a very long time also, and it shows no sign of abating. So given that, the positive change in sentiments is the one one key important signal that is coming out of these indicators. And another thing I just want to add is the NCER Business Expectation Survey actually covers a whole host of firms with less than 1 crore, annual turnover of less than 1 crore, to firms greater than 500 crore. So these is when we one of the first things I always check when I look at the survey results is what's happening to the smaller firms, the one less than 1 crore and 1 to 10 crore. And we find that when sentiments improve there, then we know that that's one of the key positive signals that comes out. Of course, the eastern region, that is, we do the survey in Kolkata, is always behind others. But given these assumptions based on the available data, we find that rainfall data, once you put in the actual number, the percentage Y&Y increase is 9.3% in 16-17. The BSE movement based on ARIMA modeling comes to 2.7%. It slightly revised upwards from last time. The bank credit to the commercial sector, again based on data, is coming around 14%. Total expenditure at the central level, 10.8%. This is from budget documents. World GDP growth is 3.2% based on the IMF World Economic Outlook. We take a weighted average of both 16 and 17 indicators. International crude oil prices is negative 7.1%. And if you again look at the data on a detailed basis, you'll find that actually crude oil price has been relatively stable for the last 4 or 5 months, despite the everyday news. If you look at the monthly data, it's around 45, 46. Dollars a barrel. Non-fuel commodity prices have been assumed to be negative 1.8%. FDI inflows 30%, but the elasticity is very low to growth. Foreign institutional investment is also 10%. Net invisibles have been assumed to grow on a 5% Y&Y growth rates. WPI energy is 2.6%. And here I want to flag something. When again, because of base effects or because of actually crude oil prices going up, WPI energy is actually showing some upward movement, steady upward movement. In September 2016, WPI fuel was around 5.6%. And if you do an ARIMA modeling, it actually tends to go up. So I think while food inflation may be tapering down, one needs to keep a watch out for the WPI fuel. Exchange rate has been actually completely, Maitri is right. It has been actually been stable. Even last quarter, we'd assume 67 rupees per dollar, and it's been fluctuating around that. This investment, as per the budget documents, is 36,000 crore. Very briefly, we have two models. NCER has two models. One is the quarterly model, where we use quarterly data to forecast the GVA at basic prices. Of course, we use the old GDP numbers and link that up with the new GVA numbers, and given that we've given our data issues. What we know in 16-17 in quarter one, we had 7.3% growth rate, and based on the quarterly model and based on some of the assumptions that I mentioned earlier, we find that after the overall growth rate, because of IIP being down, of course, I'm not saying that IIP is a very good reflection of the GVA manufacturing, but even then, based on the IIP numbers, one would think that agriculture would go down. One of the key sectors that actually has seen consistent performance is the domestic aviation sector, which that has seen double-digit growth rate. Tourist arrivals have come. But another very key indicator for services we look at is cargo traffic used by both passenger roads and railways and ports. And that has shown, again, slowing down or stagnant growth trends. So when you look at that, so 16-17 quarter two, based on those numbers, the quarter two number is going down. But then again, we see, based on my tea leaves, the macro model is suggesting that we will see some upward movement, not a lot perhaps, but at least some upward movement to the thing. The readjustment leaves the overall growth rates the same, but there is, I think, there is almost, you can see a divide between the first half and the second half. The first half being not so good, but the second half we perhaps might see a turnaround. The GDP, you have an annual forecasting model, which is a more comprehensive model, and there we find that again the growth numbers are the same as what we did last time, but GVA is GDP market prices is predicted to grow at 7.6%, and GVA basic prices is slightly it's supposed to grow at 7.3%. Slightly there's upward revision. Because again, the second half of the year is hoped to be better based on the indicators. The agriculture growth is because of the actual rainfall usage. The data comes down but still the growth is still significant compared to the last year's because the growth was so much better. Industry growth rate is supposed to pick up if there's sustainability in the indicators, and services growth also we should. Because along with if steel actually picks up and so does cement and otherwise, we hopefully might see more cargo traffic going up. Of course, and along with that is exports. So if the cargo traffic also picks up, we might actually see some quite very strong movement in the service indicators also, lead indicators also. So there also we might see some upward movement in services. Exports is going to be slightly this is readjusted based, so the week exports is forecast to grow at 1.2%, imports at negative 1.1%. Inflation comes out around 3.1%, and current account is forecasted to grow around 1.1% if exports is higher than imports. Obviously, there is surplus, and fiscal deficit is forecasted to grow around 3.5% here. So on that note, thank you.
Thank you, Maithili and Bernali. This year we have two sort of special studies, and I think both are timely. One is, I think, of a much shorter duration importance, whereas the other has implications which are much more longer term. The first is on the financial sector. I think what really didn't come out in the presentations that Maithili and Bernali made was that this last year at least has been extremely volatile in terms of developments in the financial sector. And a lot of people have had a hard time segregating which way the effects have run. Has it run from the real sector to the financial sector or vice versa? So the first paper by Shomo Ghosh on the financial sector development in India, and the second paper is on aging. So I'll ask Shomo to make his presentation, please.
Good morning, everyone. I think when Barnali told me to make a presentation on this financial sector development, initially I was a little hesitant, but I think after going through and trying to put up what has been done in the short span of time, I think we found out a lot of interesting things which could be a topic for discussion in the coming days. See, what we have tried to do in the paper and also in the presentation is that I think in the last 2 and 3 years, I'll not say 2 and 3 years, I think since 2013, there has been a lot of changes in the financial sector in development in India. That's why we call it a new paradigms. And most of these changes have been ongoing. Lot of these changes has been made by the Apex Bank, Reserve Bank of India, and that's a continuous process which has started in 2014 and is still continuing. And the second is also the welcome thing is also the government has also chipped in terms of its objectives. So these two actually, the government and the RBI has tried to make a lot of changes in the financial sector developments, which we can call a new paradigm. Some of these changes are now visible, but most of the changes as we move forward in the course of the presentation will be visible and have an impact in the coming days. So what I have tried to do, I have tried to sum up most of the changes which have happened during this period. I call it a 4-pillar development in terms of what has been happening. The first pillar is primarily the oft-repeated claim of an sound and vibrant corporate bond market in India. As we know that there has been talks about the corporate bond market, depending on the bond market in India since the Patil Committee report in the 90s, and it has been continuing. So it is nothing new, but this time there has been a lot of visible changes which has been made by the Reserve Bank of India in terms of a specific direction, so which actually are very welcome. The second, which is a logical corollary, is that reduce the process of financial intermediation and dependence of the financial sector on bank credit. So that's another thing, and which is a logical corollary. Here also the central bank has taken a lot of steps. The third is basically, which is again a byproduct of pillar 2, is deepening the banking system for smaller corporates and borrowers. So this is happening as we are trying to reduce the financial intermediation space. So therefore more smaller corporates and marginalized borrowers are coming into the field. So here we are seeing a lot of technological intervention on the part of the existing banks and entry of new players. For example, payment banks, small finance banks, which the RBI has been playing a leading role. The fourth pillar is, in addition to all this, is basically transparency and recognition of assets and policy making and better public disclosure. So this is again an ongoing process, because as we know that the banking sector has been going through a lot of stress in the last couple of years. There has been instances of this stress in the banking system in 1994, in 1998, and since 2013 also there has been a lot of stress. Fortunately, we are almost now close to the bottom or at the bottom of the cycle, but there has been a lot of changes in the RBI has been nudging the banks in terms of recognition of the bad assets and moving forward. So that is one part of the transparency. The other part of the transparency, of which the RBI and the government both has been equally responsible, is of policy making. For example, monetary policy making is now more open in terms of a monetary policy committee, in terms of an inflation targeting, and also the government has made its intention clear in terms of setting up an PDMA, the Public Debt Management Agency, which will separate the debt management and the monetary management function of the RBI over the next 2 years. And there has been also better public disclosure. So these primarily are the 4 pillars of the financial sector development which has been happening in the last 3 to 4 years. And based on this, we'll discuss each of the pillars in detail, and then also what could be the possible future steps, or what are still the gaps which needs to be filled in the course of such discussion. Now, in terms of the development of the corporate bond market, I think, it's a fact that you need to have a vibrant corporate bond market for the robust development of the financial system. There is two very important statistics over here which actually throws a lot of light. In the last 5 to 6 years, I think there has been a significant growth in the corporate bond market. Even though the size of the bond market in India around 17% of GDP, it's much lower than what even the East Asian countries have. But there has been an increase of 2.6 times over the last 6 years, from a number of around 8.3 lakh crores in September 10 to around 22 lakh crores in September 2016. So that's an increase of 2.6 times. If we make a comparison of the scheduled commercial banks outstanding credit, so over the same period, there was an increase of around 2.2 times. So around 75 lakh crores in September 2016. So in essence, the size of the Indian corporate bond market has actually increased at a faster pace after the financial crisis, and I have not bifurcated the 6-year period. If we actually look into the last 2 years, the growth could have been even faster. So basically the ratio of 2.6 to 2.2 could be even further loaded in favor of the corporate bond market. So this basically reflects the cautiousness on the part of the Indian banks, and there has been a lot of discussion on this. One of them is possibly not to add to the risk-weighted assets because the banking sector has been going through a stress, to strengthen their balance sheets and to clean their balance sheet possibly. And the other important thing is that we also know that the Basel III requirements are now in place, and the banks need to save capital for meeting the steep Basel III requirements, which will be rolled out in full capacity by 2019. So that's the first thing. So that is why the discussion comes, so why the corporate bond market actually has been picking up space. Now, even after this, and I think a lot of this has been discussed in the paper also, there has been some failures of the corporate bond market and which could be up for discussion. For example, it is still inaccessible for a lower rated borrowers. The borrowing is dominated by a lot of NBFCs and a few public sector undertakings are all well documented, so I'll not get into them. But in June, I think in August 2016, the Reserve Bank had taken several steps to strengthen this corporate bond market in India, some of these which were under the course of the discussion. And some of this I'm mentioning over here, a discussion and the impact of these are mostly have been discussed in the paper, but just to make you aware, an enhancement of the credit enhancement limit, enhancement of the credit supply of large borrowers, which actually has a lot of implications for the market, and I will dwell into in great detail in the latest subsequent slide. Allowing corporate bonds under RBI LAF, which has been a long-standing demand for the market, because that will make the market more liquid in terms of more trading in corporate bonds. Introduction of electronic dealing platform and corporates being allowed to do less than 7-day term repo. The portfolio investors can now trade directly in corporate bonds, and the banks will be allowed to issue masala bonds. In fact, I think just 2 days back, the RBI has issued the circular that the banks could actually issue masala bonds for Tier 1 and Tier 2 capital, and this is going to strengthen the investor base, because right now there is an inadequacy of the investor base in terms of the Tier 1 and Tier 2 capital for the banks. Now, there also has been other things over here. There has been concurrent steps which has been initiated for examining the feasibility of whether we can have a system of crowdfunding in India, and this is a very interesting topic, and in fact the RBI and SEBI has issued consultative papers on this one. But I think that is going to take a little amount of time, because there are significant challenges in the P2P lending. I mean, for example, the most important is that they don't have a physical presence. Sometimes they use algorithm to assess credit worthiness of the borrowers, and as you know, in India, credit risk is a huge problem. That's why the banks sometimes find it difficult to price the risk. So this model without a digital trail will not give meaningful results, and that is also a problem because we are a cash-driven economy. There has been a bust up in Chinese industry in 2015, where many companies have actually seen their bosses disappear, leaving the investors in turmoil. So that's a problem with this corporate bond, and the RBI consultation paper fortunately addressed many such concerns, and it has clearly said that if we want to have a system in India, we need to have a physical presence of these players, and also stringent capital requirements for such type of lending. So, but still it's in a consultative phase, and I am not sure how much that portion is going to pick up in the coming years. But there is some discussion which has already been initiated in the market domain. Now, if I take the pillar 1 forward and make a logical corollary of the pillar 2, is basically, the CBM broadening is try to reduce the financial intermediation by encouraging corporates to move away from bank-based lending for better price discovery. As you know, in India, the 70% of the total loans are from the banks. I'll give you this figure in the subsequent slide, but one of the important reasons why the bond market has an important role to play in the financial system is that it can price risk much better than what a bank could actually do, and that has been sometimes the bane of basically the defaults in India. For example, there is a participation from long-term investors like insurance companies, pension funds, so they could actually discover prices much better than what a bank could do. And there is also the bond market can take higher risk with unsecured lending, as risk can be spread between a large number of borrowers and savers, which is unfortunately not the case always in the banking system in India. So therefore, the move for a better reducing the financial intermediation is actually a good step and in the logical direction. Now, if I look into some of the data, the US financial system is actually disintermediated with around 30% of outstanding corporate funding coming from loans. In India, this comparative figure is around 70%. Interestingly, Europe, I think the figure is higher than 70%. So this is one important data I wanted to highlight. Now, what has been done to get into this financial disintermediation? Two things I would like to mention over here, and which is very important, is that the RBI has actually come out with a framework so that the large borrowers can get onto the market more often than to the banks, and they have said that over a period of 3 years, by 2018, they will have to reduce their dependence on the banks for taking loans, and if they continue to have that dependence, the banks will have to make that extra provision. So that is one thing. So basically the idea is that will encourage borrowers to tap into the other source of finance like the corporate bond markets. But here I have some numbers. I don't know how much this is going to be successful because there are some issues. For example, we calculated, if we go by the planning commission estimates, which is now is not there, but the estimates at that point of time there was a deficit which is calculated that the debt market, there's an 11 lakh crores funding deficit for the infrastructure sector. Now the size of the corporate bond market today is around, I think, 22 lakh crores. So at that point of time there was a funding deficit for 11 lakh crores, and we calculated that if this has to be done, because around 55% of the total borrowings from the banks is from the large corporates. So that means that over the period of 3 years, around 7 lakh crores will be made free because of this rule. So that means close to around 20 lakh crores has to be mobilized from the corporate bond market. Now the size of the corporate bond market is 22 lakh crores, and it has grown from and the number has grown actually in the 6 years. So we are making the task very difficult for the corporate bond market. So we are saying that it has to grow to say around 45 lakh crores or say even 50 lakh crores over a period of 2 to 3 years, because that is the time when this credit supply for large borrowers will come into existence. So I am not sure whether such a challenging figure, whether we'll have any difficulty in terms of the infrastructure sector financing in India. So that's the first point. The second thing is that there is again a logical corollary is that for the bank side, the RBI is also making a conscious attempt to shift the bank borrowing in India more towards the market funding. For example, in Indian context, the total, if you look into the asset liability structure of a bank, most of the banks, including our bank, has a liability of more than 90% of the total liability is towards retail deposits. So therefore, in such a system, if that is the case, so that is also the RBI is trying to reduce that number. For example, there has been some policy measures which has been taken, like retail participation in treasury bill auction through non-competitive bids and so on in April 2015. But here also, India is a country where social security is not present. So this method could actually take a large amount of time than what is currently envisaged. And also the fact, if you go through the literature, and it has been discussed in RBI papers also, there has been a discussion by Patra in 2015 on this contagion effects, which clearly says that because of this nature of this Indian bank's liability towards more of liability being towards retail deposits, it makes it easier for them to fund up the global contagion. And there is existing literature also on this, so I am not sure how much that is going to be successful, but nevertheless, these are some of the steps which has been taken to process to increase the process of financial intermediation. Now, third pillar, which again is a logical corollary of the second pillar, is that as the financial disintermediation encourages large corporates to move towards corporate bond market, it will open up enough space for the smaller section of the corporates and borrowers to access the banks. So basically the small and medium enterprises and also the marginalized borrowers. So this again is being achieved in two steps. First, the banks are actually using now significant technological intervention to bypass the many layers in subsidy payment. I am talking about the Prime Minister Jan Dhan Yojana. Till now, around 25 crores of account has been opened, and for example, if I give you some numbers from our bank, if I take all the financial inclusion accounts which our bank has opened in addition to PMJDY, the total account are now close to 10 crores. So, and each account has now an average balance of around 1,000 rupees. So that means that 10,000 crores amount of money was somehow hidden in the rural economy, which has come into the forefront because of this measures which has been taken. And I think the banks are using the significant technological intervention to make the subsidy payments routed to the last beneficiary. So that's the first thing. So basically bringing the marginalized sections into the banking stream. Secondly, the RBI has also playing a good part. The set of payment banks and small banks licenses, and there are non-bank system providers they are putting in. For example, Paytm is one of them and others. So there is a technological disruption is now made possible. So banks should either develop their own capabilities or seek proper alliances. Very quickly, a point I would like to mention over here is that there is a lot of discussion on the payment banks. I think the idea of payment banks is an excellent idea, and the fact is that the payment banks will take away the deposits from these existing banks is not true, because there is a restriction on the total amount of deposits up to 1 lakh. The payment banks can take up to 1 lakh, and which is only 9% of the total deposits in the banking system. So that argument is not correct. But the payment banks restrictions, the restriction which has been put up by the regulator are quite strict, and that actually could act as a disincentive for more of these banks to come into the mainstream. So this we can have a little discussion if you want, but there is both a positive and a flip side to this setting up of these banks. Now, finally, if you look into the pillar 4, there has been a policy transparency and disclosure. There has been several steps which the RBI has taken over here. As if you have been following the RBI steps, one of them is the 5 into 25. The RBI has been done the strategic debt restructuring. Recently, the RBI has come out with a new policy of S4A, and I think these policies are very well taken by the market, because this has been mostly been a demand for the market in terms of having some policies whereby the banks get some time in terms of moving ahead. And also on the policy side, apart from the asset quality, now there is a new regime of inflation targeting with a monetary policy committee. So the government and the RBI are in complete sync in targeting the headline CPI, and the RBI has also moved into an MCLR funding, so which actually addresses the structural impediments of the policy transmission in the banking system. So there is a policy transparency and disclosure part also. Very quickly, I think how these asset quality of Indian banks has been done. The latest is the S4A, the structure of the stressed assets. This actually and these schemes, most importantly, the schemes has been an improvement over the earlier schemes. So that's a good part. So earlier there was the 5 into 25, then there was the SDR scheme. Now the RBI has made this S4A scheme. And the important thing is the S4A scheme is that here the banks will get some time to get a new buyer. There could be a conversion of debt into equity, and so therefore every policies which has been taken over here is an improvement over the earlier policies, and it gives the bank some leeway to move over from the current stress scenario. Now, the other things is that the central bank is also helping the banks in terms of the capital requirement and the LCR implementation. And as you know, the capital requirement is a challenge for the banks. There are several estimates in the public domain. I don't want to get into them in terms of the capital which the banks need. Some of these, say in terms of lakh crores, 2 lakh crores, whatever. But the good thing is that the central bank has taken several steps, like the sale of non-core assets, monetization of the real estate assets, raising capital from the market, and etc. So which actually will give the banks a lot of leeway in reducing their capital requirement. And there is also an LCR requirement which has been prescribed by the RBI. So all these policies are a part of the policy transposition and better disclosure on the part of the banks to move ahead. Now, very quickly on the inflation targeting, but I don't know, I mean, inflation targeting in India is a new concept, but it is going to be a little bit challenging because the history of food inflation in India doesn't suggest that it has been lower than, 5% or so. So basically it will have a challenge, but again the good thing is that the government has taken several steps, so that means that's how we are seeing a food inflation even in the range of 4 to 5%. Now, the other thing is that there has been also a liquidity framework now. The RBI has moved to a neutral liquidity, so there is now a synchronization of the monetary policy strategy and stance. So basically, stance is the accommodative policy and strategy is the neutral. So now both of these are synchronized. So that means that the banks are finding it easier to transmit in the current scenario when the liquidity is in the neutral mode, and that exactly is happening in the MCLR regime, because in MCLR regime every month the banks are cutting rates in baby steps. For example, in the last month there was a reduction in MCLR by 15 basis points by most of the banks. The other thing is the Public Debt Management Agency, which the government has notified, I think 1 month back in the beginning of October. It is going to do it in the next 2 years. Again, it's a good step, and hopefully it will be a success in India, because unlike other countries, Indian fiscal deficit composition is very much loaded in terms of the domestic debt and not the foreign debt as most of these countries have seen. So this will be a welcome move which will help the RBI to focus exactly and exclusively on controlling inflation. What are the challenges and future roadmap? If I look into the corporate bond market, there are still some steps which has to be taken. For example, there has to be an institutional mechanism which could allow the SMEs to tap the market. There has to be a repository of compulsory reporting of all information which don't have related to private placements. There is very poor quality of data related to credit risk. I think there has been steps in this direction, but more steps need to be needed. And of course, an active credit derivative market, because otherwise that will not be able to accurately price risk. In terms of the banking sector, I think recently one thing is the news of the cyber security, and I think there has to be growing discussion on the cyber security. The banks should try to improve the current defenses in addressing cyber risk, and even the RBI needs to be, very mindful and plug any vulnerabilities in the quest of some cyber security. So that's one area where sufficient, work needs to be done. The other thing, which is maybe atypical to a public sector bank, is basically the talent and skill management, because the banking sector, and here the government is also moving ahead, and here in terms of seeing how the HR issues could be addressed for the banks, because there is a lot of restriction on the part of the public sector banks to hire from the market or to have a proper HR policy or giving ESOP. So these things need to be sorted out because the next 2 to 3 years there is a lot of retirement from the banking system. So there is going to be we call a middle management crisis in the public sector banks. The other thing is which I would like to say, and then I would end, is that the fintech services, we talk about this making India an economy whereby everyone should get internet, but let me send you some figures over here, and which you need to be very cognizant of that. This BharatNet progress, is a very slow progress, and it aims to connect around 2.5 lakh gram panchayats, but till date only 9,000 has been done and across 21 states. So this project is seeing a cost overrun of almost 70%. Unless we work on this BharatNet progress, the progression of digital technologies in the rural areas will be very difficult to adopt. 4G auction is one case where there is no demand in the 700 and 900 megawatt band. So that basically gives an idea that digital financial revolution will not reach rural areas if there is no policy objective of utilization. And finally is the customer servicing. So if we are in a world whereby there will be more of millennial customers accessing the banks, we need to have a proper issues on customer servicing, because the future of banking in India is going to be web based, and any poor quality may constrain actually the future of digital financial access. So with these words, thank you.
Thank you, Shomo. May I now invite Devashish Barik from NCAER to make the presentation on aging.
Good morning, everybody, and thanks to Dr. Sen for introducing me. And I think living longer is our long-term intention, and living healthy is what we should be thinking of. And my today's presentation is aging in India, some health issues. So the outline of the presentation is like the background little. Then population aging, what is the global scenario, and some facts and figures on aging in India. Then socio-demographic profiles of Indian elderly. Then the linkages between aging and health, and the health scenario among Indian elderly, and some challenges faced by Indian aged population. So a short background that what population aging means. If we divide the total population into various age segments, we find that the population age 60 years or over are generally called as aged population, and the population which are between the age group 15 and 60, they are regarded as the productive population, or they contribute to the economy, whereas in literature it is told that the younger age population or population below age 15 years and above age 60 years, they are the dependent population per se, but it is debated over time. So over time we see that in our population, mainly due to demographic transition, the population of younger age, that is age 15 years or below, they are getting reduced, and the aged population or the seniors of age 60 years or over, they are getting the higher end. Population aging is the process where the proportion of elderly population in a population gets heaped up. And in almost all development debates, we talk about this demographic transition and demographic dividend, that India is going to reap the demographic dividend. But we already overlook the invisible but gradual increase of the elderly population and the challenges they are going to face in coming decades. Why challenges? Challenges means most of the elderly populations are mostly out of the labor force. They suffer from their deteriorated health condition. Social ties in our culture is gradually weakening, and more numbers of women population are there in their higher age range. What is the global scenario of population aging? You can see that almost all the world regions, they are aging, but aging in Asian region, you can see that it is aging first. This is, you can see a steep rise in the this is the yellow bar. It shows that aging in Asian region, it is showing a steep rise mainly. Africa, aging is there, but it is a slow process. The curve is showing flattered. Now, aging in India, how it is occurring? Unlike the aging in developed countries, aging in developing countries are much faster. India mainly, this is the figure from last census, that in India 8.6% of the populations are beyond age 60 years. Kerala is heading on the process, and Assam is slowest aging state. Prior to 1991, from 1951 to 1991, only 37 million elderly population were added to our population, but after 1991 to 2011, 57 million elderly has been added to our population. So we are aging fast. Socio-demographic profiles of the elderly in India, mostly 52% of elderly populations. This is I have taken from India Human Development Survey, which is a premier survey conducted by National Council of Applied Economic Research and University of Maryland. We have around 22,000 elderly sample in the last round, that is 2011-12 round of the survey. There we find that 52% of the elderly are female, and most of them are in their lower age bound. 37% of them are widowed. Again, among these 52% of the female elderly, 57% are widowed. Then most of the elderly live in joint families. Joint families defines living with their spouse, children, and other family members. Then 57% of them are illiterate, and nearly 70% of them are living in rural areas, and 67% are not working. They are out of the labor force. Aging and health linkages in aged phase, mainly beyond age 45 years, people gradually get into afflicted by various non-communicable morbidities like diabetes, hypertension, heart disease, etc. So in India Human Development Survey, we had 15 major morbidities we have identified, and we asked the persons or respondent whether they were diagnosed with either of the 15 ailments, which includes diabetes, hypertension, then cancer, cataract, etc. So we find that beyond a certain age, all this prevalence of these major morbidities that gets increased for both male and female population. And this is the picture I borrowed from the Global Burden of Disease Studies conducted in 2013. There we find that beyond that within the period 1990 to 2010, most of the red segment mainly signifies the communicable diseases in the population, and blue is non-communicable diseases. We find that within 1990 to 2010, this higher segment in 1990, that is communicable disease, that is getting reduced, and this blue segment is widening. This signifies that non-communicable diseases are gradually increasing in Indian population as well. From our data, ISDS data, we find that within the first round and second round, that is 2004-5 and 11-12, these are few of the major morbidities listed there. All the major morbidities are increasing in their prevalence, but any difficulty in performing daily activities, where we counted 7 activities mainly, whether the person was available or able to walk a kilometer without help, then he can dress without help, he can see easily or hear easily, like this. We counted 7 activities of daily living, and we asked whether they were facing any difficulty to perform these activities, or they were completely unable to perform that activities. We find that around 30% of the aged population were finding it difficult to perform their daily activities, whereas 11% were unable to do either of the 7 activities. Elderly health and cataract is one of the major morbidity prevalent in the elderly population. Other higher prevalence of chronic morbidities like high blood pressure, heart disease, diabetes, all are rising, but more prevalent is in the urban population than the rural population. And if you go back to the earlier slide, you will find a clear difference in the reporting of the ailment. These all are reported ailments, and you find that the high BP, almost all people, irrespective of rural or urban, they are aware about whether blood pressure was there or not, but they are less aware about whether he was affected by heart attack or not. If it is a mild heart attack, most of the time it gets unnoticed, but major heart attacks attracts medical attention mainly. So there is a higher under-reporting of the morbidities, but then also we see a visible distinction between rural and urban. And expenditure, whether there was socioeconomic differentiation in seeking treatment on these morbidities, we find that from people, households with elderly, we find that poorer households are spending less, whereas rich households spends more on treatment of these major morbidities. This signifies that there is chances that these morbidities in the poorer population are mostly undiagnosed, whereas rich people could afford to go to the doctor and diagnose these morbidities. Challenges, the decline in traditional value system and joint family system in the wake of the modern working life mainly. The people are more aspiring and they are mostly involved in the modern job, and the value systems are declining, so declining the familial support system. Economic insecurity is there, and this leads to a higher psychological stress among the elderly people. And lack of social security and inadequate facilities for healthcare, rehabilitation and recreation, mostly because most of the geriatric care centers are concentrated on tertiary level, and these tertiary healthcare centers are mostly concentrated in higher urban sites. And pension and social security are restricted to government employees and organized sector employees, whereas only a few of the elderly in their old age are employed in these sectors. We find that 75% of the elderly females are out of the labor force, and 30% of the elderly males are out of the labor force. 72% of the elderly still live in a joint family, where majority of them suffer from psychological stresses. Moreover, number of females in the old age, they are bigger. We have our old age support system in our policy. We have national old age pension schemes, Annapurna Yojana, number of programs are running, but they are not sufficient to support this elderly. Health insurance are there, but a few, and if they are, the premium is too high to include the elderly. They are not inclusive mainly. So we can conclude that the risk of non-communicable disease are rising, and elderly among the higher and middle income strata, they are more likely to be affected by these non-communicable diseases. There should be some higher number of geriatric care centers at rural places as well, as we notice that 75% of the elderly population lives in rural places. We can develop some multidisciplinary team, mainly with the help of specifically trained personnel to meet the geriatric need of the population. Uneven expenditure for major illnesses among elderly from various economic groups call for government's intervention to help the poor to get diagnosed and get treatment from these ailments. And lastly, treatment is something which needed to be done, but promoting the youth to take up nutritious diets and enhance physical activities, those are the main causes of getting these non-communicable diseases. We should promote these type of healthy behaviors to help our elderly in long term. Thank you. Old age homes. Thank you.
Well, thank you, Devashish. Now we've been at it practically non-stop for nearly 2 hours, and so we'll take a little break and we reconvene when? In 15 minutes?
15 minutes would be
11:30.
Too onerous. So let's let's get here at 11:50, 11:40. Yeah, 11:40. So 25 minutes.
25 minutes. Okay.
Shekhar had to go, so I
will
be sitting with you, but
Lovely.
you are chairing. Thank you.
Well, can we settle down, please? We are beginning now. After those 4 presentations, we have 2 discussants, and then we will open it up for open discussion from the floor. So may I invite Dr. Indira Rajaraman to please give her views on what has transpired so far.
Thank you, Chair. I'm sure we all agree that we had an exceptionally rewarding morning. I congratulate Maithili and Bernali and the whole team, and of course the 2 individual paper writers for having put together a great deal of information. I have only 10 minutes, and so I'm going to be very selective in terms of what I pick up to comment on. First, let me begin with the overall presentation by Maithili Bhusnurmat and Bernali Bhandari. Would I be correct in characterizing your stance as one of cautious optimism? Yes. I probably go with that, broadly speaking, leaning more towards caution than towards optimism. Many reasons for that, but let me just pick up on one that worries me greatly and is an important reason for my caution going forward. Maithili, you did the public finance portion of the presentation, and I don't believe you mentioned the 7th Pay Commission at all. Bernali mentioned it, but in a positive light. Bernali, you saw this. Where's Bernali? Bernali, I want to see you. Bernali mentioned it as in a wholly positive light as a possible source of a demand push. Let's just go back a little bit in history and look at the fiscal impact that past pay commissions have done, have had. This pay commission increase, of course, is nowhere nearly as stark as the 5th pay commission and 6th pay commission were. But if you remember, the 5th pay commission, remember what we've had so far is just its impact on salaries at the union government level. And I believe even the impact on allowances has not come in yet so far. This is going to spread over the entire country, from the northeast to Kerala. It's going to spread to every doctor, every teacher, every employee in a parastatal, every researcher over time, over the next 2 to 3 years. And if it doesn't spread, we are going to, as we have just seen, we are going to have suicides. If pensions are not adjusted in accordance with the union increase. So this is an extremely serious matter and something that we have to factor in going forward. Now, if you look back, the 5th Pay Commission brought about such fiscal turbulence that it was that which gave rise to the FRBMs, right, at the central states, right? The 6th Pay Commission did not cause so much fiscal turbulence only because it coincided with the global crisis. So the fiscal stimulus that was brought in accommodated that, and somehow the Pay Commission itself was not incrementally at fault for the fiscal decline that we saw afterwards, or the rise in the deficits. Today, is it at all surprising that when the 7th Pay Commission is poised to work itself through the country, the union government has appointed an FRBM commission to see if deficits can be placed within a range? So what we need at this juncture is a responsible evaluation of what this is likely to do to fiscal deficits going forward, whether in view of the stagnation in the economy, we should view it as a positive, as Bonali has so far, as a possible source of a demand push. What will it do to public debt as a percentage of GDP? And we all know that rating agencies watch fiscal deficits very carefully. So what will it do to our rating? What will that in turn do to investment and so on? So there are multiple implications of this Seventh Pay Commission, which I believe we do need to look at this juncture because it's so very worrying. So throwing that into the pot, that's why I lean more towards caution than towards optimism. That's one point. I can't dwell on that much longer because I have to move on. Maithili, you very rightly pointed to the need to emphasize manufacturing simply because of the employment implications of that. Although I do disagree with you on looking at manufacturing as solely the only possible source of incremental employment, because I think you can have the service sector, not just not just the computer sector, but other non-computer service sectors be a source of absorption of the farm laborer from his bullock cart. But on manufacturing, the chapter was written by Saurabh Bandyopadhyay. Is he here? Okay, not here. All right. Saurabh did a good job, I thought, of looking at the index of industrial production and looking at its infirmities. As you all know, we have a replacement for the IIP around the corner based to 2011-12. So hopefully this will improve things a little. But for the moment, we have to live with the IIP that we have. And Saurabh has pointed to the discord between what the IIP shows in terms of negative growth of manufacturing and what GVA figures show in terms of value added in manufacturing. So he has left the issue open and said that this is one of the reasons why we really can't say for sure what has happened to manufacturing in the last 6 months. But one of the very good things that he did was to do a seasonally adjusted month-on-month indicator using the IIP data. That was a good thing that he did. He also had a tuckaway table in which he presented the data from the Purchasing Managers Index for these same months, which also, as you know, is seasonally adjusted. Although I wish he had juxtaposed these two, either in chart form or in table form, I was happy to see that what he got from his seasonally adjusted MOM IIP was broadly in agreement with the improvement shown by the PMI. And this is even before the sharp rise in the PMI in October, since we're dealing with the first 6 months. October doesn't figure. The only point of discrepancy between Saurabh's MOM from IIP was that it showed, I believe, a dip in September, and his showed a dip in August, and the PMI showed a dip in September. So there was some discord in terms of direction. I'm perfectly aware, as I'm sure all of you are, that PMI is not really a calibrated index. It's really used to point to directions. So there was directional congruence between Saurabh's MOM and the PMI MOM, except for these 2 months, in August and September. Directionally, they were moving in opposite directions. But there is a story of improvement there in the MOM, so that leads to slightly closer agreement between the GVA data from the GDP series and the IIP. So I'll just leave it there. A minor point in passing, the RBI, one of the things they do to deal with the infirmities of the IIP is to clean out the outliers and to obtain an adjusted IIP with the outliers removed. And I think that has worked well in the past. So that's one thing that could be done for a very quick correction of the IIP. Hopefully all of this will not be needed when we move into the new index of industrial production. So that's all for industrial production. If you'll permit me, I'll just go back to the fiscal subject, which I was too quick to move on from there. There's just one point that I want to mention. There's very disturbing evidence over the last year or two that faced with the imperative to stay with announced fiscal deficits and faced with claims like Seventh Pay Commission and so on, a lot of expenditure flows from the union government, which were budgeted and approved and so on, are not actually flowing. So, Maithili was speaking about how the economic plumbing has improved. The fiscal plumbing shows signs of deterioration. And, very respected departments of government like the Department of Atomic Energy, institutions like the Tata Institute of Fundamental Research are suddenly facing obstructions in fund flow, which they are wholly unused to. Now, of course, critics of these institutions might say, they've had a very comfortable time so far, living off the taxpayer, and that they need to prove their worth or whatever it is. That's a different matter altogether. But I think this failure in the fiscal plumbing is an extremely worrisome thing, and it's something that is not visible. It's totally opaque. Because what you see are the deficits reported, and it's only when the next budget rolls around that you will see that the revised expenditures or the actual expenditures are much below budgeted expenditures in order to find out what really happened. So that is very worrying on the fiscal front. So that's fiscal and manufacturing. Let me move on to the financial markets segment written by Pallavi Chaudhary. Is she here? Yeah, hi. I liked what you had. You had a huge range of things that you covered. Just 2 points. One is, when you're talking about the repo rate in monetary policy, you have to remember that that's just the policy rate, and that the operating target is the call money rate. Okay, so if you want to know whether monetary signaling, which is very important for monetary transmission, right? I mean, unless the signal is issued, transmission is not going to happen. So I wish you had included, along with what has happened with the repo rate, which is a step function, I wish you had also showed what is happening to the call money rate, and more importantly, to the dispersion around the mean call money rate. I think there's a lot that can be learned from there about the coherence and therefore the quality of the monetary signals. Okay, that's very important. Stressed assets. Here again, this is a very, very commonly made mistake, which is that when you look from the end of March 2015 to the end of March 2016, and you see the very sharp rise in gross NPAs, right, as a percentage of gross advances. This is commonly attributed to the asset quality review, which took place in December 2015. Okay, you've done that too, right? Now, the asset quality review was a monitoring event. Okay, it was monitoring of a change in definition. The regulatory change kicked in on the 1st of April 2015, and it was actually announced 2 years previously in a policy announcement on 30th of May 2013. What Dubri Subbarao did at that time was to say, with a forward effect of 1 April 2015, any loan which is restructured even once will be classified as an NPA. So that is why, leading up to that date, there was a pell-mell rush by banks to restructure their loans, because they knew after the 1st of April, the guillotine would fall, and then they wouldn't be able to restructure anymore. It would become an NPA. And that is why when you look at stressed assets today, it has a much higher NPA component and a much smaller stressed assets component, a restructured component. Okay? So I wish you had gone into this story, because it is very important to attribute it to that change in regulatory definition and not to the AQR, which was a monitoring event. Okay? Now, the AQR was admittedly an aggressive monitoring event. Okay, so it wasn't monitoring of the kind RBI normally does. It was deep dive monitoring. Okay, so they really went into the companies which had borrowed, made a judgment as to whether those loans were likely to need restructuring in the future, and asked that banks recognize them immediately as NPAs. So it was aggressive monitoring, but it was nevertheless monitoring. It was a monitoring event. It was not a regulatory change in definitions. It's very, very important to remember that. Okay, some of the increase in NPAs may well be a result of the AQR, but the bulk of it is a result of the change in the definition. Okay, so that is one thing. The other thing that is very important to mention in this connection is that if you look at that 30th May 2013 regulatory release, the regulatory change with forward effect, one of the things it said was, however, if there is a change in the date of commencement of commercial operations, because the borrower is not able to get government permissions, he can extend his loan servicing, the period over which he doesn't have to service his loan, by anywhere up to 2 years. 1 for non-infrastructure and 2 years for infrastructure. That was an amazing relaxation, if you like, of regulation at a time when regulation was actually being tightened. And this, in turn, was a recognition of the fact that the entire economy, including the borrower and the lender, all live at the mercy of the government, broadly defined, not just union, but union, state, and local, and getting permissions to get the bijli and the pani and the whatnot in order to get their commercial enterprise going again. So this, once again, Maithili, is another reason why I lean more towards caution than towards optimism, because I'm not certain that that permit raj, which still stays with us, we are still in a permit raj, whether it's really being tightened on that front, and whether there is any more transparency or speed or efficiency or quality on the government's front in terms of permitting new enterprises to come into being. Finally, this is my final comment. I hope I'm within my time. Yeah. The Ghosh paper on financial the financial market, basically banks and so on. Minor comment. I frankly didn't see the distinction between your pillars 1 and 2. So I think the development of the corporate bond market goes hand in hand with disintermediation. So I thought you could usefully collapse them into one and make it a 3-pillar approach. Now, the most substantive comment I have to make on this is the following, and here I have no answers to give. I'm just asking the question. One of the things that worries me about the GST going forward is how financial securities will be treated within GST. Okay, it's clearly the security can't be treated as a good, so the tax cannot be levied on the value of the security, but there has to be some taxation on the value of the financial service rendered when a transaction takes place. How that's going to be taxed, some people is not clear. Some people have suggested that, there's no, you can't do a CGST, SGST on it, because the point of origin of a financial transaction, maybe one state, maybe some other state, it's very, very confusing. So some people have suggested that maybe we should just have an IGST, assuming that all financial transactions are interstate. What that will do to the efficiency of financial markets is very unclear to me. So this is a question I'm asking you, whether this has been discussed within SBI, or and whether there are any recommendations that you are making to the government on this. Thank you.
Thank you, Indira. May I ask Dr. Subhashish Gangopadhyay to give his comments, please?
Thank you, Pranab. I must confess that I'm not a macroeconomist, so I don't know why I'm here. But after listening to Shekhar, I know why I'm here. I was born into a Bengali household. So what I will be talking about is a little bit about what we are doing in the media review, how I see it, and what are the things I think should be discussed or delved into when doing a media review, or which I would like to see, not being a macroeconomist. So, most of the things that we do in media review, especially in India, looking at things that are clearly outcomes. Right? And then much of the policy discussion that we have is on how to ensure that next time those outcomes look good. So, for example, I'll just take up from what Indira just said in terms of the financial markets. When we look at NPA and all, of course, when incidents like Vijay Mallya's hit the headlines, we immediately try to make sure that how to bring about regulation so that such a thing never happens again. But we never ask the question that it's not just Vijay Mallya, it's just that we have too much of NPAs, and just by regulating them away, we are not going to stop NPAs. The more correct question to ask is, why is it when India is trying to grow, there is a huge amount of pent-up demand, there are people looking for jobs, there is apparently a lot of money to be invested, why is that not happening? I think that's the most serious question to look at, rather than run to create regulation that of course may stop Vijay Mallya, but may also stop all investment. right? So that's a very serious thing. See, in other words, we have to go beyond the outcomes when we are doing these media reviews. Now, I will give an exact example, again picking up from what Maithili said in terms of inflation. She said that the rural sector has a higher inflation, especially in food, as well as in other things, compared to the urban sector. I remember when, in my younger days, when we were looking at data, and we tried to do, poverty lines for rural, urban, different sectors and all of that, we invariably took the urban sector prices to be higher than the rural sector prices, right? And we, derived various indices based on that. And here you're saying that the inflation rate in rural areas is more. Now, this is where we need to go.
Higher.
Sorry, higher. That's what I said. More, yeah. I'm okay. So this is where we need to go a little bit beyond, and this is also something that Maithili said at the end of her talk, which I think is very, very important. Whenever we look at average figures in India, we are actually hiding a story rather than telling it, because and also I think the hoopla, or both the hoopla as well as the criticism, regardless of which ideology you come from, against the central government, I think, or for the central government, I think is totally unfounded. Because barring the financial sector and barring some broad things like trying to keep Pakistan at bay, I doubt whether the central government really plays that big a role in today's Indian economy. It has to be the states, right? And that should be a signal to us to also start disaggregating our findings when we refer to the Indian economy. But to give a more specific example, if you recall, in 2008, prior to the financial crisis, we had a huge increase in inflation rates, right? And there was a big talk, a lot of policy issues, a lot of discussion and all of that. Now, if you broke down that data into disaggregated forms and essentially, chose two groups of people in the urban area, urban non-poor, I shouldn't say rich, urban non-poor and urban poor, and in the agricultural sector, you broke them up into four groups: the pure laborers, agricultural laborers, and then small, medium, and large farmers. Then you could see that barring the urban poor, everybody was being positively affected during that time, including agricultural labor. Why? Because the nominal wage increases were much more than the food price inflation. But we were so involved, and for the others, medium and small farmers, you have to do, sorry Maithili, a little bit of mathematics to get to the net benefit rate to be able to argue that they were also doing better. And therefore, this focus on inflation, and luckily for us, we didn't do much during that inflation phase, even though there was a lot of talk of what the RBI should be doing and all of that. There's a lot of write-up in the papers for asking the government to do something. We would have really, excuse me for using this term, we would have screwed up the entire economy if we tried to intervene. The one thing that was done by the government at that time, which was the right thing to do, is through ration shops, more commodities at given prices were distributed, which is what the urban poor target would have been. So if we just follow the fact that the inflation rate is going up, we would have missed this entire story, right? So that's the reason why I'm saying it is good in India, because we are so diverse, because our country is so fragmented, both in terms of economic classes as well as, of course, social classes, is that it's important to do this little bit of disaggregation. Another comment that was made was about bank-based, and I think here also we need some rethinking. There is a lot of talk that has happened again in the macro literature, right? Especially if we read The Economist and such magazines, which Maithili, for a very different reason, right, mentioned in a rather pejorative way, if I can say, yeah. But it's good, because we should stop reading them and start thinking a little bit, not because they are wrong, but because, we are making the same mistakes, right? In the sense that if I look at you said that India is largely bank-based, which would suggest that there are economies which are not bank-based. Now, the reason I'm saying this, I'm not arguing with you, in fact, you're right, but the important point I want to mention is that there is a lot of talk in the press and in the magazine media, right, on the role that venture capital plays in the U.S. in terms of startups, employment, and all of that. The interesting thing is that if we look at the data, not anecdotes, not the Googles, right? But if we look at the data, it is shocking to find that the majority of startups are created by banks in the US. I'm not talking of India. And since in India we are talking of new employment, new investment, and people usually start small before they get big, right? So if that is what we are looking for, we need to have a bank-based system. If we are trying to follow the modern financial markets, the modern way which Shauma's thing really clearly presented, that we are moving to an enabling framework in financial markets, maybe slowly, but we are getting there. But if we want to use these avenues, if we want to use these sort of infrastructure, then we have to let banks play the role that they're supposed to play. They're an intermediary to match investors with savers, right? So that role of banks that we have in India should not be forgotten. We should not try to become a US, Europe type economy just because, bank-based is not the right way to go. That's what the economist says, right? So that is a point I wanted to mention. The other thing I wanted to say, and this, since Indira is here, let me say that I first started thinking about this because of a comment Indira made many, many years ago at a discussion of this type, where she said, if you recall, Indira, you said that when we talk of second or third generation reforms, the thing that should be our focus are changes or the environment surrounding factors of production, right? And she mentioned land, labor, capital. And I think that is a big issue, and maybe capital has little bit to do with the center, but certainly land and labor are, bang in the middle of state issues. Right? And therefore, whatever the central government does or tries to do can enable, but it cannot get the results that we want unless the states do something about these issues. Right? This is a big question. I don't know how we are going to look at it, but I think that in our mid-year review, it would be great. It would be great if we can have states moving towards better direction so that we can talk about them and signal to others that that's the way to go and get the corresponding outcomes within those states to be able to argue that, see, this is why it is happening. Because that would be, really a good sort of information which would also probably energize other states to follow suit. And finally, I have to mention something about skilling, and then I'll make two brief points on health and financial markets. You quoted Shakespeare, right? Now, in that same play, Caesar also says about Cassius, right? He says, "Yon Cassius has a lean and hungry look. He thinks too much. Such men are dangerous." Now, in India, we are at that position. Why? Because we have people who are getting skilled, people who are getting educated, and people who are not getting jobs. And hence they're lean and hungry, right? But they're also educated, so they think a lot. And this is something which is very, very serious. I don't see a movement on this, and I'll give an example. We talk a lot about skill gap. Almost everybody you ask, they're talking about skill gap. And as an economist, I've always wondered, what is the skill gap that we're talking about? The skill gap is not only in the formal sector. Because in the formal sector, you can say, the labor market is not open, there are restrictions, and all of that, those things you can say. But let's take even the informal sector, the informal labor market, where also there is a skill shortage. I don't understand the meaning of skill gap, because as an economist, if you have an open labor market, what is the idea of a skill gap? So we started digging deeply into this, or trying to figure out what do people mean by skill gap. And the thing that amazes or really struck us is that we are doing a program by which we are trying to get skilled people and get them into employment with the private sector, with the employers who are devising the training program and certifying and hiring them, and then people leaving the jobs. Why? Because the salaries are too low. Now, if that is the case, if people after getting trained, after being certified that you're good enough, after the employer saying that yes, you can work in our factory or in our organization, if these workers now walk away saying that the salary is too low, right, it gives me a completely different picture of what we mean by skill gap, because when we say skill gap, one usually believes that employers are searching for skill, wages are going up. Right? That's what happens in a free labor market. If I'm looking for skill and there are very few people with that skill, then the wages tend to go up. If you look at the wages in the so-called skill, and there are various things, and the NSDC has described what the skill issues are. So this is very easy to check, that the wage rates in the so-called skill gap sectors are simply not moving. So we are probably saying the wrong thing when we talk about skill gap. And this, I think, is where the investment climate, the land issues become very, very important. And I think we should start going beyond, just the outcomes that we see. Now, very quickly, when it comes to the financial markets, I think I read a lot of what Shomo writes, right, in his usual SBI, what do they call, reports, right? So the only thing I would like to say is that the financial markets are moving slowly, as I said before, but they're getting there, but that will not solve our problem. Right? It will definitely solve some of the distortions that are there, but it will not solve our problem because the financial markets enable things to happen. And, so it's okay. It's good it is going in the right direction. But to be able to use that, we need to have some changes in the real economy. And for the old age, I can only say I'm extremely delighted and happy that there are such young people worrying about our health. Thank you.
Thank you, Subhashish. Unfortunately, I have to leave in 5 minutes, so I will just make very brief comments from the chair, and then I'll take your leave, and I'll leave the chair to Dr. Chadda, who will conduct the rest of the proceedings. Well, just a few very brief comments. Let me begin with something that Maithili talked about, which is the whole issue of what is happening to private investments. I think it's very important for us to actually disaggregate between private corporate and private non-corporate investment, because what has been happening over the last 4 years is there's been a rebalancing in the Indian economy in favor of private non-corporates, which means that the dynamics of our private sector over the past 4 years and in this year is significantly different from what it was in the mid-2000s. And I think we need to be very clear about this. The second point I'd like to make is on the issue of employment. It's actually quite weird. You talked a lot about manufacturing and the importance of manufacturing for employment. The second largest employer after agriculture is construction. And it's not so much manufacturing growth that's holding up our employment. It's the fact that construction has done absolutely nothing for the last 5 years. And that's something we need to think about, because it again takes us back to a lot of the points that Subhashish is making. That what are the skills are we looking for? If you go and ask the manufacturing people, most of them are really not looking for skills. Go talk with the construction people, they are. And that's the transition that takes place from the farm to non-farm activities. The third issue is, again, it's linked to what Subhashish said. One of the striking features of what has happened over the last few years is that in the Indian corporate sector, the compensation to employees, which is wages and salaries, has grown faster than their top lines, much faster. So when we talked about profits not going up, it's that your value added is going up, but more of that value added is actually being paid to the employees than being retained by capital, number one. Number two, what's happening is the amount that's retained for capital, a larger amount is being paid out as dividends rather than being retained as retained earnings and reinvested. So there are two changes taking place there, which are very significant for the investment analysis that you've done. The third point is you talked about improving productivity. The fact is, over the last 5 years, India has seen much higher, faster improvement of productivity than it's ever seen before. The numbers are quite staggering. It's not that we don't have a huge amount of way to go yet if you're talking about the global productivity frontiers. But the fact is we've actually experienced very high productivity. Problem with high productivity is it doesn't lead to employment. It leads to income growth, but it doesn't lead to employment. So if you want to look at employment, for God's sake, don't look at GVA. Look at what's happening to the value of output, or the volume of output. It's the physical output which matters, not the value added coming from it as far as employment is concerned. The third thing is, the most dramatic thing that's happened in the first half of this year is that we have reversed a 3-year trend that we'd been observing, which is high power money supply growth was extremely low during the previous 3 years, and that process started getting reversed from April this year. And we've seen actually in the first 6 months very high rates of high power money growth. And in a sense, we're trying to make up a backlog in liquidity. But in order for you to be able to project anything, you really need to be able to make some statement about how do you see that process going forward. RBI has already made some observations on what their intentions are. But then, the way you interpret those intentions and the way you think the RBI is going to act on it makes a huge difference to what happens. Finally, let me just, linked not to that, but again this issue of rural inflation. One of the things that has come out of the NSS surveys right from the early 90s is every time we've done an NSS consumption survey, the consumption basket in rural areas has been expanding at a very rapid rate. So that there is a convergence that's taking place between the number of goods and services that are consumed in rural areas as compared to what's consumed in urban areas. Right? Now, when that happens, the way we think about flows of goods has to change. Our old mindset was goods came out of the rural areas to urban areas and stopped, got consumed there. What's happening now is agricultural products are coming to urban areas, then getting retransmitted back to rural areas which are in some other place. So the whole impact of trade and transport is now being borne much more by rural areas than by urban. And that was the old argument that was made for why urban prices were higher. So now it's actually just reverse direction. Okay, I think that we need to take that into account because this is going to continue to happen. And finally, on this issue of the financial sector, Shomo, one of the things we need to be very clear is that India followed the Anglo-Saxon tradition of banking. We didn't follow the European universal banking model. Since 2002, the universal banking model has been brought into India by the back door. In all our analysis, and this continues to happen today, we simply do not make a distinction between the credit that's flowing to the non-agricultural sector in terms of whether these are working capital loans or term loans. And it makes a difference because working capital loans are really about current production, whereas term loans are about creation of capacity for future production. Now, if we don't take this into account, we will make a serious error in our estimation of what's going on. So we tend to treat the bank lending as if it were a continuum going over the last 40 years. It isn't. It's changed very dramatically since then. And with those words, I thank you all, and I unfortunately have to take your leave. Thanks a lot. Rajesh.
Sir, just one. Sir, we want to release the last year mid-year review,
okay,
which is placed in front of you for.
No, you can take it. You can take it. Okay, it remains for me to first thank, since Dr. Pranav Sen is leaving. Thank you very much for coming, and
no, pleasure.
You've been with us earlier also. So thank you very much for very thoughtful comments that you have made. And thanks also to Dr. Indira Rajaraman and Dr. Subhashish for being with us this morning. And obviously thanks go to the earlier presenters who are from NCAER. We will be, as we do every year, we release the published document of the earlier presentation last year. And I was wondering, since we started, this is our 6th year, and we were earlier, but it started in 1976. So let me also compliment IIC and the organizer. This is the 40th, 1976, 24 years plus 16. So this is the 40th year of media review presentation which started. And let's take one more minute with you, and please. Let's release it.
Yeah.
Okay, please.
When you're releasing something, please don't make the package so good.
Yeah, I'm finding it. आप इधर आइए. Thank you. Thank you very much. This was too good. We'll take care of this. Okay, we have had a wonderful discussion, and since Dr. Shah had to leave, and he said that I should be taking over and discussing. We are moving into open discussion now, and I would like to invite comments from the floor, and since it is being telecast, if you can introduce yourself and then make a comment, and please make brief and pointed comments and questions. Thank you.
I have a small request. If I can have the question anything, please, I have to leave in 5 minutes.
Oh, okay. Okay. So if somebody has questions on Shomo's presentation, particularly, please raise them now, and then we will. So first hand, second hand, and any other hands, because he has to leave in 5 minutes. He says, "Yes, sir. Your name and question, please."
As Maithili began by saying, this year's economic review, media review, is very much like last year's. And what it shows is that the economy is fairly satisfactorily growing at around 7.5%. The other parameters, balance of payments, the fiscal situation, and so on, savings rate, investment rate too, are reasonably good. So what is the reason for the sort of suppressed or part suppressed pessimism? Why are we, or NCAER, worried that we are not achieving a higher rate of growth? Now, this is due to partly due to the Economist, which has introduced us to a zoo of tigers, elephants, tortoises, and the rest, which are really not significant. But for the last 4 years, that's the last 2 years of the UPA government and the first 2 years of the NDA government, we've had an implicit ambition that the growth rate is going to go up to 8 and then further. And then somehow we are going to get into a kind of China-like situation. Now, there's absolutely no reason to suppose that this is likely to be achieved. So if that is not the case, then suppose we begin simply by accepting that we are at a fairly optimum rate of growth and that we have to adjust our ambitions accordingly. Now, there is a parallel to this in the international economy. There's been this, again, over the last 2 years, this dissatisfaction that growth has not resumed at the pre-recession rates. And now theories of secular stagnation have been developed to justify this. Now, I don't think we need to develop any theory. I think we simply need to accept, like Japan has accepted a long time ago, that there is a natural, achievable rate of growth, and we should adjust our ambitions accordingly. Now, this has certain policy implications, and that is what I really want to talk briefly about. That if we are not likely to grow rapidly and reach a higher level of development, then some of the decisions that have been taken are still being taken on investment, and the horizon of investment horizon need to be reviewed. Now, if we had not abandoned planning, this would have been the year for beginning a mid-plan review. And if that were to be the case, if we do that, we will find that there has been substantial overinvestment in certain sectors, particularly for the public sector in infrastructure, which is geared to reaching within 5 years or more this higher level of 8% to 10% growth. And then in the private sector, the real estate development, which is geared to continuous high rates of growth, well beyond what we have achieved. And as a result, we're landed with what is a minor or a reduced version of the China position, that we have now large amounts of likely infructuous investment. So this is going to lead to, it has already led, it's the main cause of the bank's NPA position. The banks have lent to these large infrastructure ambitions, and if we are not going to have development corridors and high-speed trains and all the rest of it coming in the near future, then the banks are going to keep on losing money. So this, having said this, the real problem, I think has been mentioned here, is that, all right, if you accept my vision, as it were, of reasonable satisfaction with the rate at which we are growing, then what do we do about employment growth? Because the entire policy framework on employment is posited on a higher rate of growth, particularly in industry. And that means not only in manufacture, but also in construction. Because if we do not get that 8% plus rate of growth, then the visions of employment growing and filling up the gap between the levels of youth unemployment and today's employment is not going to occur. So that is, I think, my concluding remarks really are that let's think about that. Let us try to restructure our policies on less ambitious growth targets and take the present distribution of employment, which is not in large-scale manufacture, which, as everybody knows now after the revision of the national income statistics, that the employment is very largely, the growth of industry is in the intermediate sector, and in the intermediate rural sector and the intermediate urban sector. So I think our policies have to be geared to try to adjust, to encourage that growth and not this rather impossible vision of becoming a small China.
Thank you very much. There are many questions involved, and I think I had invited for some questions for Shomo. And if you can choose, pick and choose some of the comments that have been, and you had the second hand raised, please introduce yourself and please be very brief so that, and be brief to his.
Yeah. Alamdar Abbas, and I am very brief because most of the points have already covered. I would say here, my name is Alamdar Abbas. Vast disparities between high technology economy and low technology economy. The transfer of high technology economy into low technology economy so as to benefit everybody, rural and urban development simultaneously. Point number one. I am very, very brief. And secondly, I would say here, stable tax and stable tax policy framework is essential to move Indian economy forward of goods and service tax GST. And Union Government of India is showing a path of monolateral and multilateral in this direction. And current Union Government of India is making India to more powerful nation of the world under the leadership of current Prime Minister Dr. Narendra Modi ji. I hope, but here I would very, very brief. Firstly, drastic changes. Secondly, consequential development. Thirdly, increase robust growth. Fourthly, stop the depreciation of Indian economy. And finally, very, very brief, economic viability and quality governance is essential to make India more powerful nation of the world, dream of current Prime Minister of India. Thank you very much. Alamdar Abbas.
Thank you, Mr. Abbas, for your question. And I think I see Lavish, and Lavish would obviously focus.
I very much agree with your point, sir. But I just want to share.
Shomo, one more question, and then you respond.
There are two very critical parts which I think I would like to. I mean, when I come to the mid-year economic review, I want to know, first of all, what are the good things that are happening, and what do I need to be very careful about? I mean, so that's the role. You may not have the time to be able to go into the reasons why things are happening in a particular manner. But at the same time, if I am talking about growth and the strange situation where we are on one hand saying at 7.5% growth and nothing else seems to be in sync with those numbers, then it would be good to look at the second set of numbers as Subhashish had mentioned. But I would still say that the one big problem that we are facing is that around 200 million people are going to enter the workforce over the next 1.5 decades. Right? And that's a huge thing, and we have no clue how that's going to be addressed. Manufacturing is not going to be able to handle it, neither is agriculture, and probably not even services. So I think at NCAER, you should be highlighting this fact that, listen, this is a big problem, and we don't have solutions. Just imagining that manufacturing will grow from 13 to 30% and take care of 200 million people is obviously it's not going to work. Second point, minor one perhaps, but I think it is critical. We do not look into import data. It's the most critical metric, I feel, to looking into the macro situation. And imports have been consistently going down despite a relatively stable rupee. And we really don't understand why that is happening, it seems. There seems to have been a minor spurt, but again, I believe if you correct for commodity prices, then that also goes down. So I would have liked to see a little bit more about on imports and what's really happening to them. On the banking side, it would have been nice if you could have linked the very slow movement of banking sector reforms along with some of the other measures, because I think that there is a massive, I think, pushback from the banking sector, and we are not seeing really the major changes that you require in the banking domain, not the payment banks, but the actual banks. So that's it. Thank you.
Thank you, Lavish, and back to Shomo because you have to leave, and if you can.
very quickly answer the questions whatever raised, and also some questions I may address on the banking sector also in terms of the credit growth, which with your permission, Maithili. The first thing, I think Professor Rajaraman raised a very valid point about that GST being a destination-based tax. So it's basically is going to be a huge challenge on the banking system, because it's destination-based and services are actually taxed as a place of rendering the service. And banks, as you know, have variety of services, ATM, point of sales, online. So if you go by that, it will be almost an impossible task to do that. So basically, what we have suggested is that the place of the supply should be location of the service provider. So either the branch or the ATM. And so, but these are actually under discussion. For example, I'll just give you some numbers which are mind-blowing. Rightly, I mean, for the GST, we have demanded the single registration facility should be provided to banks, because as per the model GST laws, I mean, any registered entity will have to required to file 3 monthly returns, 1 annual returns, which will be 36 returns in a year. So for a bank, for example, like us, which has an operation in all states and union territories, you multiply by the states, multiply by the number of returns, this will lead to a filing of 1,296 returns in a year. So these are actually, this will lead to a humongous multiplication of the compliance cost. All these issues have been getting discussed. So I think there is no unanimity as of yet, but hopefully, at least as this destination-based tax is concerned, I think there should be some, because it will not be possible on the part of banks to have a distinction between GST, which is mostly destination. And regarding your second point of these, whether I can club the Pillar 1, Pillar 2, yes, that could be thought of, but I just thought I will make the Pillar 2 a little bit, try to make it a little bit different, because there has been a lot of changes which are being made for this to reduce the scope for financial intermediation and what are challenges. So that's the reason. Otherwise, one follows as an offshoot of the other. The other argument, I think, which Professor Gangopadhyay mentioned, I just wanted to also actually second that, is that yes, it's absolutely correct in the case in a country like India. I mean, most of the banks, most of the startups have been provided by the banks. So you cannot deny the role of that. And when these crowdfunding rules were, and we have written in the paper somewhere, is that when these crowdfunding rules have been developed, we have said that this is a good step which the RBI and the SEBI are doing, but they need to be mindful of the fact that at the end of the day, that revolution may also have to be done by the banks, as has been the case in the Europe. So that's the other thing. The other thing regarding the point on this credit growth, which have been mentioned repeatedly, let me tell you some very minor facts on the credit growth when the things became larger, and then Maithili can add to it. The first thing is that there is a distinction of definition in the credit growth. For example, so that current numbers are not comparable on the retail credit, on the credit growth banking sector. As you know, because of the Uday scheme, 1.5 lakh crores of loan has gone from the credit book to the investment book. So the base is actually not comparable. If I add that base today to the credit growth, there is an increase of around 3 percentage points. So basically, the growth goes from around, say, 9.5% to 12%. So that's the first thing. The second thing, important thing, is that in the credit growth, there is a lot of repayments is happening. For example, in our banks also, a lot of corporates are actually deleveraging. So that money is coming back to the system, and I think that's a very healthy phenomenon, because at the end of the day, if you don't have a clean balance sheet, investment revival will not come up. So you will not see any credit pickup in the coming days. The final is that the oil sector is not taking any loan. 20,000 to 30,000 crores of oil sector is because of the low oil prices. There has been actually no demand. And also the fact that the banks, and I think this is the point which Professor Strain also mentioned in terms of the working capital loans and the term loans, I think a lot of banks are now investing in the commercial paper. For example, for our banks, we have invested in the first of around 30 to 35,000 crores in the commercial paper market. So this is basically the loan for the working capital loans. And for a bank, it is not possible to go back to the level of the commercial paper interest rate, which is 100 to 125 basis points lower than the MCLR at this point of time. So my sense is that you will see a clear distinction in the days ahead in terms of the banking credit growth. There are some positive to it. Obviously, there are some negatives to it, but the good thing is that it is also leading to some sort of a corporate leveraging. The other point which I want to mention before I end is that there is a lot of talk about this jobless growth in manufacturing. But let me give you one alternative viewpoint to it. You may not agree with that. I think the current government approach, because India is a country, if you look into the NSSO survey, a large part of the country is actually self-employed. More than 50% of the people are self-employed. So the objective of this current government is actually to increase that self-employment level. I have some hard numbers with you in terms of the Mudra loan, for example. Till now, around, I think, US 30 billion. So basically, I mean, close to 2 lakh crores of loans has been disbursed under Mudra loan. Now, on a conservative estimates, this Mudra loan has gone to 5 crore of units. So basically, even if I assuming that those 5 crore units, each of them employs 2 persons, that means the total employment is in the 10 crore, which is equivalent to 100 million. So basically, and a lot of this actually, we did a study with an SBI sample and found a lot of this actually are going to the women entrepreneurs. So there is an material difference in terms of the job growth, because the government has understood it will be very difficult to push the manufacturing sector growth rate in the short term given the complexities involved. So they are trying to take different ways of doing this, and we are seeing results on that, and that basically is one way of looking into the manufacturing job sector growth rate. And finally, I think regarding to the point which Professor Lavish made regarding the banking sector reforms, I think I tend to disagree a little bit, because banking sector, a lot of reforms have been taking place. And if you look into actually what the RBI has been doing in terms of the asset quality review, in terms of the schemes which the government has taken, I agree with the fact that some of the schemes the government is going to be taken is very politically sensitive, because there is a clear demand from the public sector banks at least to push down the level of government holding to below 50%. But I think that's going to be a very politically sensitive issue, and I'm not sure whether how the government will do that. There are talks about differential voting rights and other things, but there is something which is happening on in the government, and it is going to do something clearly on the HR issues, because HR, I think the public sector banks are very much handpicked. For example, if a public sector bank like State Bank wants to hire anyone from the market today, there is a Supreme Court order that you cannot hire anyone from the market, even from institutes like IIM Ahmedabad or IIM Kolkata or even MDI Institute, even though you may have majority stake, because you are a public sector organization, so that job has to be made available on a piece of paper to 1.2 crore individuals. There is a Supreme Court order on that, so therefore you cannot go and hire from the market in terms of the lateral entry. So these are some of the things which have been raised in the public domain, but the government is working on it, but I am not sure how quickly these reforms will be done. So in my sense, I think the points which I wanted to make is there has been a lot of things have been happening, but maybe, I mean, these are not getting addressed properly in the public domain. Thank you.
Dr. Ghosh, since you have to leave, I think I thank you immensely and for being with us. And please do share those hard numbers that you have mentioned about self-employed and Mudra loans with Barnali. And also for the information of many of us who don't know, NCAER is carrying forward a major project on education, employability and employment, for which the recent conference was held just a month ago, 5th of October. So we are doing a lot of work on education, employability and employment, but I think she would be publishing soon. The papers are yet to be published.
The numbers are already there in that paper, Mudra loans. I have given the papers. So
okay. Thank you very much. Thank you. You would miss lunch with us, and we will miss you over lunch. Okay, can we now carry forward with open floor discussion? And I would like, I'm noting the hands, but if okay, to 3 questions, and then I'll give it back to. Okay, yes, please introduce yourself and ask your question. Preferably precise.
My name is GB Bagai. As a layman, I have some perceptions. I'll just take a minute or so. Number one, when we talk about employment and manufacturing, and we say that, construction is going down and firms are not hiring, and we talk about skills, and skills are so important, and yet they're not hiring. I think the reason may be because there's technological disruption, and firms go in for highly skilled people, and normal skills which we talk about are not required, and they get very poor salaries anyway. That is number one. As far as aging goes, I think pollution should have been mentioned. We're surrounded by it. It's affecting our children as well as the aged. And I don't know what percentage of GDP is affected by pollution. Lastly, exports and imports. We are not East Asia, and as was mentioned, that why are imports going down? I mean, one of the most amazing things I find is that we still carry on with inverted pyramids. And then we talk about lack of manufacturing. Unless the spare parts are made cheaper than the final product, how are we going to increase our manufacturing? And in any case, I've always felt that the rupee was undervalued. It should, it increases FDI, FII, it brings down inflation. We are spending thousands and thousands of rupees, crores of lakhs of crores of rupees on defense. All that would be cheapened, reduced if the rupee was, the value of the rupee went up. That should be taken into account when we keep on talking about bringing the rupee down. That's it. Thank you.
And we already have 2 sets of questions. So this was the 3rd set of questions, and one more from you, and then we'll give it back to the presenters and our discussers.
Both the discussant and the presenters talked about reforms being required at state level. I agree with that, of course, but I would like to suggest that transmission of policy reforms and process reforms from center to state is now beginning to take place. But there is a blockage further down the pipeline. The transmission of reforms from state to districts is an area where major blockages are existing right now. If we see ease of business statistics, most of the places where there is a low ranking are really at the district level, not even at the state level. So I think we really need to perhaps make our study little more granular and go down what we need to do for transmission of reforms from state to the district level. This is what I wanted to say, one. And secondly, Navish talked about manpower or the employment. Yes, that is true. It's impossible virtually to absorb the entire population into manufacturing or services and so on. But really, I believe we need to think a little bit out of box. Why are we sticking, even today, at 48-hour week? Why don't we consider reducing the week so that people are less stressed and employment for doing the same hours of job can increase? These are 2 things I want to make in that.
Yeah. Sir, can you introduce yourself?
My name is Sarvesh Sharma.
Okay. 4 sets of questions now, lest the presenters forget. So let them first answer this round, and then we'll have another round of questions. I'll ask Barnauli, Maithili to respond, and on any of the four sets of questions that have been asked, then I'll request Dr. Indira Rajaraman and Dr. Subhashish to comment.
Yeah, thanks, Rajesh. I think I'll just respond to the issues raised by the discussants. So, Indira, on the public finance, you said there was no mention. Page 77, just a factual thing. On page 77, there is a discussion of the pay commission recommendations and how it's going to make the government's finances much more, vulnerable. So there is a discussion on that, on pay commission. So that's that. Having said that, I accept that, caution is abundantly warranted. Perhaps the reason why my optimism was not as cautious as yours is because we're discussing mid-year economic review, dismal signs as it is to start with. So I thought maybe I should compensate for that by being a little bit more optimistic than I normally tend to be. I normally tend to be quite a pessimist. So it's a little out of character, yes, but purely because I said I think there is reason to kind of feel a little bit more optimistic than normally so. On the fiscal plumbing, entirely agreed, yes, that's something that we really haven't addressed. But given the situation when the private sector is not investing, I really see no option but for the government to invest. And ultimately, growth is the final antidote to any kind of problem that we have. So if we get growth, which is a big if, I think that would perhaps be taken care of. So at the moment, I'm not so worried. I think believe the 3.5 is some kind of sacrosanct number which you just have to adhere to. I mean, look at what the IMF done. Disaster in Greece, disaster wherever they've talked about a very rigid adherence to the fiscal discipline. The question is, what are you spending on? If there is a violation of that very rigid fiscal discipline, we're spending it on the right things, I see no real great issue about that. And the IMF has been very wonderful at preaching to us one kind of language to us, quite another language to the US. If you see even Standard & Poor, Moody's, etc., they've not changed our rating or the outlook. What were the US's macro fundamentals at the time of soon after the financial crisis? Far worse than any tin pot African republic. But the rating was kept unchanged when Standard & Poor, which was headed by an American Indian, dared to talk of lowering. I think he promptly lost his job. So let's not forget the fact that ratings are very political. Okay, that's one thing. As on Subhashish's point, yes, I found your comments on inflation quite interesting because at the time he quite clearly moved to inflation targeting, and we've seen inflation targeting as a be-all and end-all of anything. It's quite nice to see a different voice. I think we need to look a little bit beyond inflation, a little bit beyond the disaggregated picture, etc. Skill gap, I entirely agree. But the issue of, why people find their jobs very low is, I think, partly a little bit social, cultural also, purely to say that, once having got a job, I think such is the force of aspirational India, because like my mate has a much more fancy mobile than I have, So I think what happens when people get these jobs, they want to immediately aspire to live like what they see in the mall culture of India. So then they find perhaps their jobs very low paying, and then they move out. And then industry is quite happy, industry, manufacturer, self-employed, whatever, because they get the next crop, willing to start at the bottom, and then before they get dissatisfied with their salaries and move out. Just a slight, not an economic answer at all. Okay, so that's about it. As far as Lavish was concerned, yes, I think where will all the jobs come from? Yes, it is a big question mark, but I think it's a bit like the Club of Rome. I mean, everybody thought, where is the food going to come from? We're all going to starve. Somewhere, somehow, I think such is human ingenuity that you do find answers. Maybe at a cost. I don't know how painful the journey will be, but maybe we will get there. As far as import data, I think, yes, why are imports falling? Purely because growth itself is, not coming really. So as the economy recovers, you will find imports also looking up. And in fact, you do see some of that happening because gold imports particularly have fallen. Banking sector, slow movement of the banking sector reforms, frankly, I think except for governance issues which are linked to political economy of ownership, I think banking reforms, in fact, have proceeded fairly robustly, I would think. That's about it. I think there were no further, and I entirely agree with Mr. Mozumdar saying that I think we need to lower our expectations. We're not going to get back to where we were before the global financial crisis. That's true not only of India, but all over the world, I think. That's it. I think Bernali can answer.
Thank you, Bernali.
Thank you, Dr. Rajaman, for your comments. They were actually very, very useful. The industry comments very useful. We'll next time put them together also. The cyclical component was actually, we started that we should not just look at a long-term trend and start looking at cyclical components to understand if there's an upturn or downturn. So your comments actually very helpful, and on the monetary part also, I can echo Pallavi's this thing. They're very useful to us because one of the things we are struggling with is when we talk about liquidity, just numbers, but when the government talks about neutral liquidity and we get numbers reported in the papers, we try to actually we don't go by the media. We try to recapture, calculate, or compute our own numbers, or estimate our own numbers. When we try to do that, we are not able to replicate those numbers. So I think would be very happy to to even see where is we know there's liquidity, but we are not just able to replicate that. Perhaps Pallavi can talk more about it. But quick. But those are some. We can go back to those issues. But I think the three. I'll just slightly take some 2-3 comments. I think one thing is skills. Dr. Maithili has already spoken about the aspirations issue. NCER did a survey in 10-11 on the National Survey of Household Income and Wealth, and where we had actually looked at aspirations of chief wage earners, not the whole population, just the chief wage earners. And there we find that most of the wage earners, chief wage earners, the aspirations were for the permanent government job, and nobody wanted to go for a vocational degree. Everybody wanted a the standard educational degree. But those are the details. Essentially is that we are doing this 2-year program on skills, research program on skills, multi-year research program on skills, which is not looking at skills from the perspective of both education, employability, and employment. And when we start digging in the data, and we have dug in, we have Pallavi, me, Moshmi, and Shaurabh, a couple of us are working on that, and we find we actually started with the skill gap question too, because that was the most relevant, one of the most relevant questions. Where are the jobs coming from? But when we started digging up data, it was extremely challenging. Firstly, of course, construction sector is where the most jobs are. So, but the construction sector is where the most people. I mean, when we look at just the basic census data, majority of our people don't even have educational degrees. They don't have any skill, any vocational skilling. And when you take those people and put them in, they're just digging ditches. So one of the things the government has come up with is, now why don't we do recognition of prior learning? When we start doing recognition of prior learning, you talk to the construction sector skill council, they're absolutely unsuccessful in doing that. So this is just one bit of our issue that we are coming from. There are no hard numbers. Hopefully, in the next phase of the work will generate some hard numbers. But this is the whole concept of employability. What is employability is itself very ambiguous. How do you define employability? Low wages is one of the aspirational issue. But at the lower end, there are people who are not willing to migrate. When we have heard that there are people not willing to migrate, despite the migration story. People looking at hard data. Somebody from ISI has looking at out-of-state migration, and they said it's relatively low numbers. So we have a host of issues that hopefully in the next few years will be coming out with these issues. The second one actually I want to talk about is, and that will actually require a separate media review. The second one is on state capacity, because NCR is also doing a very important project on direct benefit transfers, assessing the capacity of states to implement readiness of direct benefit transfers. I can just, while the government has initiated the direct benefit transfers, and already Shomo has talked about the challenges of digital financial inclusion, somebody who's working with the state governments, just state, I'm not talking about district, just state governments are struggling. It's extremely hard. We are actually not even doing this, just the survey. Along with the survey, we are doing sensitization of many of the state governments as what is DBT or how to implement DBT, and helping them and hand-holding them. So, it's one thing to have reforms at the center level. When you start going at the state level, capacity development is a huge challenge. Not only that, data is very not available. And the third, somebody again, I was part of another project a couple of years back where we worked with the state of Kerala on the Kerala perspective plan. Again, the same thing. 2 years of very rigorous work helped us bring out many issues that would have shaped. So it's not. It's somebody with working with state governments on a regular basis. It's extremely challenging, and translating what the central government is doing to the state governments is extremely challenging. And the exchange rate issue, I think, is I think exchange rate is it's a price variable. It's an endogenous price. So it's how many people are buying rupees and selling rupees. Of course, there's RBI intervention, but RBI intervention is due to I think more to mitigate volatility rather than the actual price of the rupee. One of the reasons we are very worried about the 7.3% numbers is something the point is because the numbers, actually GVA, the gross value added of manufacturing, grew at 9.1% in the first quarter, whereas index of industrial production was completely negative. Now, if you look at WPI, wholesale price of manufacturing, which is used to calculate GVA manufacturing, WPI manufacturing was completely negative throughout the year, but in the first quarter it was actually positive. So so you could potentially explain that last year GVA was doing better because of deflation. But what about this year? So the GVA numbers showing 9.1% growth, whereas IIP is showing recession on a year-on-year basis, and even otherwise, we know that we have a problem, that these numbers are not actually a reflection of some ground reality, the ground reality numbers we are getting. Even the NCER Business Expectation Survey, quarter after quarter, which I didn't report here, of course, because of constraints of time, quarter after quarter, the NCER Business Expectation Survey showing that majority of our firms, and this is across 6 cities, in urban areas, I agree, they don't want to hire workers. They just don't want to hire workers. So this the macro and the skilled labor market is of course related, but there's no creation of jobs across sectors. If there is no, I mean, we are caught in a spiral, and post 2011 our numbers, again, it will be repetition of numbers, but post 2011 we have been caught in a vortex of uncertainty. Here of course the focus is in the last 6 months and maximum up to 3 years, but the longer numbers series show that we are caught in a vortex of uncertainty, and that's why this sort of pessimism. But and here and again I agree with Maithili that it's the first time and now that after a long time you see many numbers giving the same signal, but whether it's sustainable or not is $1 million question. I mean, it's not, or $1 billion question, but it's after a long time many indicators are coming together to show some upturn. That's the only reason why it's cautious, very, very cautious, this thing. But of the fiscal deficit, we try to stick to it, but of course there's price implications and other implications, state governments. I hope Dr. Chadha is hearing it, that they'll have some 2-3 years spillover. But on this thing, so these are some of the very quick comments, but I will be happy to talk about skills outside this, because it's a much longer subject. Thank you.
Thanks, Bonoli. At this stage, Subhashish, would you like to make any comment to any of the discussions? Or
Well, I didn't want to, but I have to say one thing after what Maithili said. I think we say this a lot about the aspirations, the stupid aspirations of people. I think we should be a bit careful when we say this, because what you're telling me to believe is that I aspire to be something, and I get a job and I have none, and I decide not to take it up because I can't go to the mall. Sorry, I'm doing a caricature of what you said. But I just cannot believe this. And I must be rather stupid, really stupid, to think that this job which I have, right, will not let me reach my aspirations. If I stay out of a job, do nothing, roam the streets, I'll be able to reach my aspiration. I really have to be very stupid to think like that. Now, I don't think the young people of India are stupid. I think a better argument would be that the job I'm doing does not let me reach where I want to reach, right? Not that, if I get out of this job, I'll be able to do better. So we have to worry about what we say when we say that these are the aspirations, there are people wanting to be employed. I like Shauma's, which he indeed has written in the paper. I think that's a much better approach. And we have to ask ourselves, what are the manufacturers saying? Do they want just more from the government? Are they really being honest? I think unless we ask these questions, we're going to go around making these really, really confusing explanations of what we want to see. If you look around, ask your friends, right? People hire a driver every year, a new driver every year. Why? Why do they hire a new driver for themselves every year in this NCR region? Because there are so many people coming in from outside of Delhi or the NCR that you can always get to pay the driver the same that you were paying last year, which you cannot if you keep the same driver. Now, this is the labor market we are talking about, and nobody talks. This is criminal, the way we run labor markets, right? We are so excited about hiring and firing, where the worst cases of hiring and firing are done by us, who are now saying that they don't have an aspiration or their aspirations are going to the mall. Please, I think we should be a bit careful when we talk about the younger generation in India.
Very briefly, yes, Maithili, of course, you did mention the 7th Pay Commission in your piece on public finance, but it wasn't in your overview, which gave me the sense that you didn't think it was vitally important. Just linking up very quickly with there's a lot that could be said, but what Bonali says about state governments being in a lot of trouble on a variety of fronts, including DBT. The pay commissions, all of them, including the 7th, have in effect become unfunded mandates, which go from the union government to the state government. The union government implements these salaries, knowing perfectly well that the state governments will have to follow suit. So it is an unfunded mandate. And this is yet another one of those pressures on state governments imposed by the center. Just stop here.
Since we started around 10 minutes late, I can still have a set of 3 questions and then next lunch. Sure. Thank you very much, Dr. Subhashish Gangopadhyay, for being with us and for making very useful comments. We would have liked you to be with us. We'll miss you over lunch. Thank you. Thank you very much. And maybe before he leaves, a round of applause is... Yes, please. 3 more questions. Brief questions, please, because a lot of discussion has already gone on. And maybe 5 more minutes to go. We would have ended at 1:05, but we'll end at 1:10. I think, no, I won't be able to take a repeat question, but please.
Yeah, my question is to Mr. Health Representative. I want to say there are 2 issues which need to be taken care of. One is road accident. The second is sick leave by our people taking. In case of road accident, there was a New York mayor in Delhi, Mr. Bloomberg, he said he has reduced the road accident to half and increased the average life to double. So that makes a lot of difference with road accident. Second is if we cut down the leaves or hospitality, so it can improve the GDP to double. So I want to know whether this has some relevance to GDP, this road accident and sick leave and all these things. Yeah, Dr. Sarojit Dudeja.
So proud that we have the highest growth rate in the world today. But is this jobless growth rate is not to some extent counterproductive from the point of equity? This is one very small question. Second one about this banking system. It has been accepted time and again that this large public sector banking system is a drag on not only the banking system but the entire economy. Why no steps are taken to privatize some banks or all banking and thereby not only improve the health of the banking system as a whole, but also in the process we can also what you call the government's budgetary position can improve by the we call it solving the budget by realizing the sale of banking shares. So much of fiscal improvement can be effected so it can serve double purpose. Why this has now not been given any attention to ever since this government has come.
Thank you very much, sir. One more question for those who have not asked.
Yes, I have a question, that
Introduce yourself.
Yes. I am Manish Sharma. My basic question is that in its search for urbanization and all, is not India losing its, self-sufficiency? It used to be self-sufficient in agriculture, but now it has to import, pulses and all, food products, and which is keeping the inflation way too high for last decade or so. And added to that, with this pay commission, wages are going to go up, and it will have a cascading impact, which will hurt the manufacturing, which in case India already does not have that sort of skills, and the wages of the workers is going to go up, which will mean that it will be completely uncompetitive as compared to countries like China, Vietnam, and Philippines, And my last point is regarding the e-commerce model, so manufacturing, the process of manufacturing are changing, and with the e-commerce boom, taking place, that is always going to have an impact on manufacturing. So my point is that India should focus on domestic consumption and domestic production, and should search for sufficiency rather than on exports and all.
Okay, and you had a comment. You said just one comment.
Clarification actually.
Yeah.
Regarding Madam's comment on inflation expectation. So I agree that about adequacy of the survey, that it is concentrated only to 18 cities and not covering the rural area and about your sample size comments. But as regards comparing it with the official figures, what you are arriving, that may lead, wrong way. So that because this inflation expectation when we go and ask, it is based on the respondent's basket. So it is biased to their own consumption basket, and so that's why it is higher. And this, you may find that internationally it has been higher, even if the official figures for many countries, developed countries, it is even in negative. So that I wanted to just clarify.
Thank you. I think we are over with the set of questions. Any quick comments from Bonoli or Maithili? No? Okay. Any, madam, from you? Okay. I think I am not going to stand between you and the lunch because we are already 10 minutes. I will leave it to Dr. Bonoli Bhandari to thank, but just to, I don't want to summarize the discussion. We have had a very rich discussion. One or two points that I thought have been raised, I would like to give a comment. I don't have any final answer. They relate to, as I said, I'm not going into what has already been answered and discussed, but I'm somewhat concerned with the issue of trade and domestic self-sufficiency and produce in India, consume in India. We had this passion for decades, and thankfully, mercifully, we are out of it now. And that we know that what happened during those decades and what happened to the country, what happened to the growth. So please, for God's sake, let's not talk about country becoming the, I don't think there is any country which is self-sufficient and self-dependent, and I also am very critical of the fact that why should we export? We have domestic consumers in large numbers, so we have heard this argument earlier. So, and second comment on what is happening to the imports. You see, imports after all mirrors what is required, and when the oil prices are down, if you are combining the imports of oil as well as non-oil, it would be obviously low, and exports of oil products would be low. And imports are very seriously connected with exports. If you are not able to export, much of the raw material and inputs that would have gone into exports are not imported. So that's a very difficult story. I think I would like to thank the team. I would like to thank the two special presentations, Devashish Marik, you are here, and to Shomo, to Dr. Bonoli Bhandari, to Ms. Maithili Busnurmat, and also, Madam, thank you very much. It is always, way back, she may not remember, way back in mid-90s, when NCAER was developing a computable general equilibrium model with University of Michigan, she was one of the tough persons on the advisory board, and I had to face many questions in this room, along with Dr. Vijay Kelkar and Urjit Patel, who were on the, and I and Sanjeev Pohit and Alan Deardoff from Michigan had faced many questions. So the questions have remained tough, and hopefully you have been able to answer what she had asked. So thank you very much for being with us and kind of adding very productive comments and remarks to NCAER's work. I remember for 22 years, but maybe for much more. And thank you very much. And thanks to the to all the participants from NCAER and from outside, and the team. As she has shown, it's a big team which has worked behind the scenes, but absolutely well presented. And thanks for the questions. Thanks for your remarks. We would keep that in mind. And next time when we release this volume, it would also contain some of the answers, but some of the clarifications of the questions that have been asked. A good round of applause for everybody here. Thank you very much. Please do join us for lunch and carry on the discussion there. I'm sorry if I've missed thanking anybody, but I have missed thanking the logistics team at NCAER, which has, this has been made possible. So I won't name them all, but they are all here. You can personally thank them. So logistic teams, particularly who has been handling all the work and behind the curtains, my very special thanks to them on record. Thank you.